in thinking there might be supply constraints? Because, of course, with what we're seeing with the oil price, you would expect the U.S. shale producers to move in there.
It's a good question, but that backwardization is really interesting for two reasons. One, it's going to harm commodities traders that have been assembling lots of storage, and so the cost of storing oil is going up pretty substantially, and so a number of financial players that have been doing that arbitrage will be getting out. The near-term impact of that could be more oil coming into the system that could put short-term pressure on prices. At the same time, I think the long end of the curve, if you look at that flat curve, is really an indication that two things. One, people don't think the OPEC deal will stick long term. And the second, people are starting to worry about substitution risk with respect to oil and gasoline, which really is driven by fuel standards globally, as well as the potential for growth of more electric EVs around the world.
Yeah, it's interesting because there are some saying that OPEC, may have a deeper motive, actually pushing a bump now, but looking to drive down the future price of oil. I'm wondering then what your longer-term perspective is as well for natural gas and LNG, despite, what the near-term boon and risk might be for them.
So we're bullish on natural gas. We see it as kind of the bridge fuel for kind of the environmental standards set by the Paris Accords. You're seeing lots of substitution of diesel-fired power in places like the Caribbean, Latin America, and Africa with natural gas-fired power. And natural gas is quickly becoming a globally traded commodity, no different than oil. And when you look at kind of investments we've made over the course of the past year, it's indicative of that. We made investments in the Marcellus Shale in the U.S., drilling for natural gas. We made a private preferred with warrants transaction with Rice Energy, a U.S. publicly traded energy company that operates in the Marcellus, really financing their pipelines to get the gas from the Marcellus and dry gas Utica out of the Northeast. We made an investment in a pipeline that's going to connect that same natural gas gathering system to the Gulf Coast of the U.S., and we made a $1 billion investment in a subsidiary, convertible preferred, in a subsidiary of Cheniere for their Corpus Christi LNG export facility to take those natural gas molecules and export them to London, as London moves off of coal to natural gas and wind-fired power and potentially nuclear over the long term, and to places like Latin America, where we now have made an investment building a regasification facility, and we're building a gas-fired power plant near Santiago. So it's really kind of thinking of the value chain of how energy, where it exists in abundance, needs to go places where there's less of it.
You think of commodities as sort of on a downward trend, right? I mean, there's been obviously the super cycle, but right now a lot of them are sort of on the way down, as it should be if progress continues. Have a look at this chart of copper. It goes back as far as we can to 1985. It's obviously nowhere near its highs back in 2011, 2010, but we are in an uptick again. Is this primarily to do with Donald Trump's, it can't be China, can it?
I don't think it's necessarily just China. I think it is this view of global inflation. Expectations are starting to rise. You see it in the bond market. You're seeing it in the commodity markets. Ultimately, the assets that are most sensitive to rising long-term inflation rates are commodities, whether that's copper, whether that's iron ore, or whether that's oil or natural gas. There's a very high correlation between how those are valued relative to expected inflation. We've been in a deflationary environment, which has obviously been very depressing on commodity prices. Infrastructure spend in the U.S. And a lot of potential borrowing by the U.S. government to fund that. That certainly would increase expectations for rising prices.
Very quickly, the odds of runaway inflation?
I'm not an economist, but I would say those are relatively low until Europe gets its act together.
All right. Bill Sonneborn, EIG Global Energy Partners President, thank you.
Thank you for having me.
Nera?
Fascinating conversation. Coming up, what could referendum votes in Italy and Austria mean? We'll ask Columbia Threadneedle Investments head of global fixed income. That's next. This is Bloomberg.
watching Bloomberg. I'm Bonnie Quinn.
And I'm Naira Chahich. This is your Global Business Report. US payrolls rose and the jobless rate fell in November, but the report may not be as good as it looks at first glance.
The fallout from the Brexit vote continues. A look at how it's impacting the holiday shopping season.
And in today's Quick Take, China has been on a shopping spree in the US and Europe, but regulators may be getting ready to put it to a stop. The November US jobs report was a mixed bag. Hiring picked up last month, with the economy adding 178,000 jobs, and the unemployment rate dropped to 4.6%. But some are urging caution, even in the face of a surging stock market. Here's Bill Gross speaking today to Bloomberg Television.
4.6 is a headline-grabbing number. It's getting close to the lowest numbers that we saw in the early part of the century before Lehman, I suppose. So that will be the headline. But we're certainly not out of the clear. When I saw the minus 0.1 wage number and the revision, or the YOY, coming down from 2.8 to 2.5, to me it indicated that things are just not as hunky-dory as the stock market seems to think it is.
Brexit is bringing Christmas gloom for a number of Britons. According to a survey by PwC, about a quarter say their holiday spending will be affected by the country's decision to leave the European Union. The survey found that Britons will spend slightly less on Christmas gifts this year.
It is time now for our Bloomberg Quick Take, where we provide context and background on issues of interest. Corporate China has been on an unprecedented spending shopping spree, snapping up companies across the United States and Europe. But not everyone's happy about it, and now regulators are stepping in to nix deals. Here's a look at what's behind all the unease.
All of these businesses have something in common. They're now owned, part-owned, or about to be owned by Chinese companies. China's dealmakers have been buying up American and European companies at a record rate. And for the first time, China's running neck and neck with the US as the biggest buyer of overseas companies. And that's making some lawmakers very nervous. So here's the situation. In 2016, Chinese companies more than doubled the record $106 billion of deals they amassed in 2015, putting them close to the US for the most overseas deals. Among the main concerns of lawmakers is whether Chinese firms, with their close ties to the Chinese government, pose a national security threat. The American regulator charged with monitoring such matters has been paying particular attention to technology deals. Its involvement led to the collapse of Chinese investments in Western digital. Europe, which has no such regulator, became a more popular target than the US for Chinese deals in 2015 and 2016. China's been snapping up German companies at a rate of more than one every 2 weeks in 2016. Germany's economy minister is demanding the European Union strengthen powers to nix deals or impose conditions on outside companies. Here's the argument. Free market proponents say it's unfair that Chinese regulations make it hard for foreign companies to buy Chinese firms, but Chinese companies are much more free to shop around in other countries. They argue that China Inc. also gains an unfair advantage from easy financing provided by government-backed banks. On the other hand, one report found that Chinese takeovers had saved many American firms from bankruptcy and that most had resulted in expansion. A study in Germany drew similar conclusions. Doomsdayers warned that Chinese overseas investment could turn into a Trojan horse that introduces the country's politics and values. Critics respond, that's a Cold War mentality. Meantime, China's companies face a new uncertainty: Donald Trump.
Think of this. They take our money. They take our jobs, and we owe them $1.6 trillion.
The US regulator with the power to kill Chinese deals will be headed by Trump's Treasury Secretary.
You can read more about China and all of our quick takes at NI Quick on the Bloomberg, and that is your Global Business Report. Head to Bloomberg.com for more stories.
Coming up, traders pairing positions ahead of Sunday's Italian referendum vote. We'll get the perspective from a fixed income manager with $180 billion under his belt. This is Bloomberg. Live from London and New York, I'm Neera Chehich.
And I'm Bonnie Quinn. This is Bloomberg Markets.
Well, traders are pairing extreme positions before Sunday's referendum vote. The spread between Italy's 10-year bond yields and their German equivalents has collapsed this week, falling more than 30 basis points from Monday's high to Friday's low. Joining us with his outlook is Jim Silinsky, head of fixed income for Columbia Threadneedle Investments, which has $180 billion under management. So, Jim, you know, we've been talking all week about how markets have been pricing in a no vote in the referendum. But if you look right now, the assets are really showing little panic. I mean, you're seeing the 10-year yields come down in Italy. Here on the Bloomberg, you've got the Italy-Germany bond spread. You can see that spread there coming down. Yeah. And 10-year bonds actually set for their best week since September. What's happening?
Well, I think a few things are happening. Number one, the sell-off was big. Number two, I think there's a recognition that, first of all, the ECB next week will continue to be a protective backstop against either the banking industry within Italy or for the periphery itself. And then I think finally a recognition here that perhaps the referendum itself isn't the key issue. That's a starting point for a number of issues that then come after. Does Renzi resign? Does it mean gridlock? A caretaker government that's either effective or ineffective? A lot of these things will take time, and so I think you see some profits being taken on some of those short positions.
Okay, so let's say it's Monday and we get the no vote, which is what you expect as well. Are we going to see a sharp sell-off in Italian and other peripheral assets? And then what happens longer term?
I would expect to see some weakness. I wouldn't expect to necessarily see a sharp sell-off until a bit more clarity comes to light. You might see weakness spread to the Italian banking sector. I think the biggest short-term issue continues to be the undercapitalization of the banking sector. The big long-term issue, of course, which is not addressed at all by the referendum, is just Italy. It's a weak point in a very weak geographic region, and so I would expect to see a little bit of weakness, probably focused on financials, and then Italian bonds to widen back out, but not severely until we get more clarity.
And so more broadly, Jim, this repricing happened, and it wasn't wholly unrelated to the Treasury's repricing either, right? I mean, that definitely had an impact on pulling up yields in Europe. Was it a one-time thing? Was it a one-time adjustment of inflation expectations, or do we continue to see more adjustment?
I think with respect to the Treasury market, you've seen a big change in expectations. Now, I think we stop here for a while, but the bear market in bonds, I think, is alive and well. And you cannot explain the level of bond yields that we were seeing just through growth and inflation, would be my point. You required an expectation that low growth and low inflation would lead to a policy response that would continue to result in big purchases of government bonds, more negative rates, and the like. I think that expectation in policy response is now behind us, and that is a game changer in my mind. So you've seen another sell-off in Treasury yields this week. Maybe you get a little bit of a breather. The sell-off, again, has been quite dramatic, but I do expect, as inflation expectations remain elevated, that you'll see yields move still higher.
What does this move in yield mean for the ECB next week? Obviously, there are certain bonds in its universe that it can buy more of now. So does that take the pressure off a little bit, or will it still try and change the capital key or extend?
Well, so I think you will see an extension. I think it's far too early to taper. The inflation outlook for Europe is still far too soft, I think, to really see any tapering. So I would expect a 6-month extension. I would expect some rule changes to go along with that. Perhaps not the capital key, but there could be some modest adjustments there to allow them to exceed capital key figures, however briefly. But they will, I think, allow for purchases at a deeper discount to what the deposit rate is. And the issue limit, I think you could see an increase there maybe to 50%. That's been a key headwind in their ability to buy enough bonds, and that will help address that scarcity issue.
Mm-hmm. You say that the bear market is alive and well. Where then are you looking for opportunities?
Well, I think there are some opportunities in inflation-linked bonds still. You can see in the charts we've presented the amount of volatility. And I think geopolitical risk brings a new environment. And so just because the bond market itself isn't always going up, there's a lot of opportunities, I think, in the volatility that we're seeing. You'll see significant rallies on policy shifts. And there's still a lot of good opportunities, I think, in credit. Corporate credit still looks fairly healthy. A lot of the Trumponomics that you see in the U.S. will actually act to extend the credit cycle. There's a lot that you can look at in those policies. We don't yet know what is adopted and what is not adopted, but we do know that corporate tax cuts, I think, are the most likely of his many platforms to be implemented. That is a net increase in corporate cash flow. And I do think there's still value, despite valuations which are not extraordinarily cheap, there's still value in corporate credit.
And I want to just ask you about the Austrian election as well, because of course that's another event that we're looking ahead to in Europe this weekend. Now, you think it'll have little direct impact on markets, but what are the wider implications and how does it affect your investing?
Well, look, we have felt that the disenfranchised middle class would be revolting against the status quo for most of this year. So for us, if we get an outcome where the Freedom Party wins this weekend in Austria, again, it's one more signpost that we're seeing that. It's probably unique in the sense that, number one, it, for the first time, really puts an anti-immigration right-wing person within the core of the Eurozone, and that probably does create a lot of questions. Perhaps it's not all bad either. I mean, some of these might lead to some real soul-searching about immigration policy. So I think it again raises questions about the Netherlands, about France, and the other elections next year. So might create some more volatility for markets as a whole. I don't expect that election to have a big impact on Monday.
Okay. Jim Zielinski of Columbia Threadneedle, thank you so much for joining us on the programme. Now, coming up on the European close, more reaction to today's jobs report. Plus, we'll look ahead to key political events in Europe this weekend. We've just discussed them. Italy's referendum, Austria's presidential election as well. Have a look at stocks. 30 minutes to the close. We are seeing downward pressure on European equities. The Stoxx 600 off by 0.4%. Losses pretty much across the board there. This is Bloomberg. It's 11 a.m. in New York, 4 p.m. here in London, and midnight in Hong Kong. There are 30 minutes left in the equity trading day in Europe. I'm Naira Chehich, in for Mark Barton.
And in New York, I'm Bonnie Quinn. This is the European close on Bloomberg Markets.
We're going to take you from Washington to Rome and cover stories out of the UK, China and Wall Street in the next hour. Here's what we're watching. A mixed picture for the US jobs report, with 178,000 jobs added in November. BlackRock's CIO of fixed income tells us what it means for the markets and the Fed this hour.
Italy's referendum approaches, and it's weighing on European stocks. We'll cover the potential fallout for politics and markets in the run-up to Sunday's vote on constitutional reform. And on the topic of the global economy, Bloomberg will have a wide-ranging conversation with IMF Chief Christine Lagarde. Don't miss this interview. It's at 1 p.m. Eastern, 6 p.m. London time.
All right, let's have a look where European equities are trading right now. We are just under 30 minutes to the close of equity trading, and we are seeing downward pressure on European stocks. Quite broad-based losses here. You can see a lot of red in the picture. We've been seeing weakness in the FTSE 100, the DAX, the CAC 40, and also the FTSE MIB in Italy, although the FTSE MIB index is actually on track for its best weekly performance among developed markets. A little bit of pullback in the dollar after that jobs report, so we're seeing stronger sterling up 0.6%, 126.65. Euro pretty much unchanged at 106.65. In the fixed income space, you're seeing yields coming down both in the core and the periphery. So Germany's 10-year yield there down 8 basis points. By the way, yesterday was the worst day for 10-year bunds in quite a while this year, I believe. And then you can see in Italy as well, we're actually seeing those yields come down. CDS lower 2 in Italy, and we're seeing a little bit of pressure on metals in the commodity space, although Brent crude holding up, in fact heading for its best week since 2009. Now, of course, a lot of focus on Italy's referendum on the weekend. I just wanted to show you what investors have been doing to hedge this. So if you look here, options traders have been driving up the cost of protection before the vote. They've basically been building up their defenses against potential turbulence, paying the most in more than 2 years to hedge against swings in the FTSE MIB index relative to the Euro Stoxx 50 index. Now, the last time the gap was this wide, Italian shares fell 11% in 6 months. But what's interesting is if you look at the very end, you can see that coming down a little. So today, we've actually been seeing a little bit of calm coming into the markets, especially as well if you look at the bond markets. I said the 10-year yields were coming down in Italy. Well, 10-year yields are actually set for their biggest weekly drop since September. And then if we look at what's happening with the euro as well, euro heading for its first weekly gain in a month. And some saying that really this is being used more as investors as a proxy for that political risk than what's happening in the bond markets. Julie?
So those declines that you just outlined in European shares, Naira, are really not translating over here to the U.S. We have the 3 major averages basically trading in mixed fashion. We have the Dow down slightly, the S&P 500 and the NASDAQ up slightly. Really, the trading feels pretty tired. Investors are digesting the payrolls report. They're also digesting the OPEC decision this week and the uncertainty around that. And, of course, the big bond sell-off in November. As for bonds today, though, we're not seeing a sell-off. We're actually seeing a bit of a rally, especially after the payrolls report. This is the 10-year yield. Bond yields, of course, trade inverse to price, and we see yields ticking down right around that payrolls report, perhaps disappointing investors because, interestingly, it was basically in line, possibly even a Goldilocks report, considering that 178,000 jobs were added, just below estimates. The jobless rate is 4.6%, the lowest since August of 2007. But what is weighing to some degree is the lack of wage growth. In fact, we saw the first negative wage growth print month over month month since 2014, and we see it there. But interestingly, this could reflect the fact that wages for utility workers went down on a month-over-month basis after being paid more in the month of October around Hurricane Matthew. In fact, Michael Ferroli over at JP Morgan, he's saying that what you should really emphasize here, the big takeaway more so, is that super low jobless rate of 4.6%. And finally, just to take a look at the sector composition of the S&P 500, when we go into the Bloomberg and we take a look at the IMAP, we first of all are seeing lots of green. Leading the charge, some of the rate-sensitive sectors such as real estate and utilities. These stocks look more attractive to investors today as rates fall. And not surprisingly, Vonnie, we have the financials as the worst performing sector as those stocks fall, as rates also fall. Often comes back to the rates, as is the case today, Vonnie.
Isn't it fascinating? Buy on the rumor, sell on the news, perhaps, Abigail? All right, that's Abigail Doolittle at our markets desk. Let's check in now on the Bloomberg First Word News. Sebastian Salek has more from our newsroom in London.
Ronnie, more meetings are set today at Trump Tower as the president-elect fills out his cabinet and senior staff. Among those Donald Trump will talk to today, former UN Ambassador John Bolton and Democratic Senator Heidi Heitkamp of North Dakota. This weekend, Goldman Sachs President Gary Cohn returns for a second meeting. Cohn's been mentioned as a possibility for several jobs, including budget chief. Trump's choice to be Secretary of Defense is a retired Marine general who goes by the nickname Mad Dog. James Mattis left the Marines in 2013 after a 41-year career. He began as a rifleman and left as a four-star general. Mattis has argued for the US to play a more assertive role overseas. The European Union's police agency warns that Islamic State is likely to carry out attacks in the EU in the near future. According to Europol, intelligence indicates that several dozen people directed by Islamic State may be in Europe now, and police say they're capable of committing terrorist attacks. And voters in Austria will get a do-over on Sunday. The Green Party's Alexander van der Bellen won last May's presidential election by 0.6%. But Austria's constitutional court overturned the results. So now the Freedom Party's Norbert Hofer is becoming could become Western Europe's first right-wing head of state since World War II. Both candidates have pledged to assert more power if elected. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Sebastian Salek, and this is Bloomberg. Bonnie.
Sebastian, thank you. Well, just a quick update now on President-elect Donald Trump's cabinet on business. Blackstone CEO Stephen Schwarzman has been named chairman of Trump's new, quote, President's Strategic and Policy Forum. Now, this forum includes business leaders such as Jamie Dimon, Larry Fink and Mary Barra. This all according to the press release out just a few moments ago. They'll be called upon to meet with the president frequently to share their specific experience and knowledge on jobs. Now, the first meeting will be held at the White House during the first week of February. Once again, Blackstone CEO Stephen Schwarzman will be the chairman of that Trump Policy Forum, Nera.
Yeah, Vonnie, it's crunch time for Italian voters, and Prime Minister Matteo Renzi with the constitutional referendum vote on Sunday. Renzi's trying to change the constitution to streamline government. Bloomberg's Francine Lacroix filed this report from Rome.
As Italians go to the vote on Sunday to vote on a constitutional reform, so therefore deciding whether the Senate needs to be curbed back in terms of the power it has, and also taking back local authority strongholds. What the people and the markets are nervous about is that Matteo Renzi has actually staked his own political future on the outcome of a referendum. He wants a yes to the referendum. He has said repeatedly if there is a no vote, he will step down. What does this mean? Well, Italy has had 63 governments in the last 70 years. If Matteo Renzi steps down, we may see more political risk, or at least the instability which investors don't want. The other problem is how do you deal with the banks? There are banks, big banks, trying to raise capital. Does it mean that investors internationally shy away from subscribing to that capital increase? And what does it mean for the smaller banks that need some kind of rescue plan if the government is distracted, or indeed if we have a technocratic government for the next couple of months? These are all questions that investors will weigh come Monday. Francine Lacroix, Rome, Italy.
Let's go right back to Rome for more on this critical vote. Joining us now is Matteo Garavoglia, a non-resident Italy Programme Fellow at the Brookings Institution's Centre on the United States and Europe. His research focuses on the European Union's common foreign and security policy challenges. Thank you so much. Great to have you on the programme, Matteo. Now, what's interesting is that until today, we were sort of seeing markets pricing in a no vote in this referendum, but we're seeing a little bit of calm settle, particularly across the bond markets today. What outcome do you think we're going to see on the weekend?
Well, we know that the polls have been notoriously unreliable, and this is something we've all learned. I think it's anybody's guess. I think that if we were to see a no vote, you would have two options. You would have Matteo Renzi resigning and the President of the Republic entrusting him to form a new government, to reshuffle effectively his government. And what you would have then would be a relatively weak government. On the other hand, what we could also see would be the President of the Republic entrusting a technocrat with forming a new government, essentially to approve the budget law for 2017 and to reform the electoral law. Everybody's eyes in that respect will be on Piercarlo Padoan, the current finance minister, somebody well respected and well known in international finance circles.
Oh, it's all right. If we do see that no vote, though, Matteo, are the biggest risks to Italy and the banking sector, or actually more broadly to Europe?
I think they're more broadly to Europe, but I wouldn't put the main risk in economic or financial terms. The European Central Bank would be ready to stand by Italy, and I think to a certain extent, as you implied, the markets have already factored that in. I think that the big risk is more medium to long term, and it is political. This development would contribute to strengthen those forces that are playing the populist card. In Italy, we have the Five-Star Movement, which is extremely well positioned to profit from this and to do well should we go to new elections, again to the ballot box. And so you would keep seeing this advance of either right-wing or more populist parties that reject European integration, that have a pro-Russian foreign policy to a certain extent, and that even questions the very own existence of the Eurozone.
Has Renzi backed himself into a corner? Does he have to resign now if he doesn't win, if this constitutional reform doesn't pass? Or are we in a new era of politics where what you say on the campaign doesn't necessarily have to be what you do in a position?
We certainly have seen that before. Legally speaking, Matteo Renzi does not have to resign. He is not compelled to do so. However, he placed so much of his own personal political capital in this campaign that he would be expected to do so.
What happens to the banks either way? You know, the slow burn of Italian banking crisis has been ongoing now for several years, and the banks seem to be fudging their way through. Does at some point this all hit, and is there a full-blown banking crisis?
Well, it's not all Italian banks that are in trouble. Some are, in particular Monte dei Paschi di Siena, the oldest bank in the world. There, I think a lot will depend to the extent to which the European Commission and European authorities will be ready to allow the Italian government to step in and to play maybe outside the rules to a certain extent, or outside the most traditional European constraints to back up these banks. And that is a political question, really, that will have to be played out in Italy at the time when also France and Germany go to the polls, and therefore I would imagine Berlin and Paris would be rather keen to allow the Italian authorities to deal with this swiftly, rather than having an escalation of escalating financial crisis starting in Italy and spreading to the rest of Europe.
Matteo, we've also, of course, got the Austrian presidential election this weekend. We spoke to an investor earlier who was much less concerned about that with the imminent market impact than with Italy. Politically, though, what's the difference in significance for you?
I can understand that they are less concerned from a financial and economic point of view. Austria is a far smaller economy and also a much healthier and stronger economy. Italy is the third largest economy within the Eurozone, and of course it has one of the largest debts in the world, both in absolute as well as in relative terms. So on the economic front, Italy is a bigger problem. Austria, in that respect, would be fundamentally a political, historical signal. We would have, for the first time since World War II, an extreme right-wing president, head of state. That person does not yield executive powers, but the signal will be very strong, and once more it would signal this advance of illiberalism and populism across the West, in the United States, in the UK, and across the European continent eventually.
Matteo Garavoglia of the Brookings Institution, thank you so much for joining us on the programme.
And coming up, the November US jobs report, the Trump effect, the looming Fed rate increase. We'll break down what the numbers indicate about the US economy. And speaking of jobs, Pennsylvania Congressman Lou Barletta says he's in the running to be Trump's Labor Secretary. Barletta tells the Associated Press he'll talk to his family over the weekend about the job, which he says has not been formally offered. He's an early Trump backer and an immigration hardliner. Barletta, known for taking a tough stance against immigrants when he was mayor of Hazleton in northeast Pennsylvania. This is Bloomberg.
Live from London and New York, I'm Naira Chahich.
And I'm Vonnie Quinn. The US jobless rate fell to a 9-year low last month. The US added 178,000 jobs. That came in slightly below estimates, very slightly. Nevertheless, the numbers show that American companies are hiring, even post the election of Donald Trump. Earlier, Daybreak Americas spoke to Rick Reeder, BlackRock's global CIO of fixed income.
We've lived in this world for the last 2 or 3 years where everything is pivoted off of how the jobs number would translate into what the Fed is doing. You know, I would argue that per the earlier discussion, Fed's moving more to the back seat. And I must say, this jobs report, it's always an important report, but I must say when we were going through it today, it's almost anticlimactic relative to what we've had in the past, because now we're moving to a different paradigm. Now we're talking about tax adjustment, we're talking about potential fiscal adjustment. That as long as we keep on this path, by the way, it's almost impossible to stay that at almost 200,000 job pace that we've been on for almost 2.5 years now, my sense is it trends down, particularly as you trend close to a 4% unemployment rate. As long as we stay at those sort of unemployment numbers, and if you get some fiscal impulse, I would argue largely through tax, then it's going to be more about growth in the economy, in the broader economy, and wage acceleration alongside of it.
I think it's worth taking just a moment to remark about where we are. We're creating, as you say, 180 to 200,000 jobs every single month. Our unemployment rate's down to 4.6%. This is quite an engine that's humming along here. Has it ever been the case that you've had this kind of situation and you've come in with substantial fiscal stimulus? Normally you get fiscal stimulus when you're going the other way.
No is the answer. No is the answer. There's a couple of points. By the way, we're looking at the numbers today. Since 2010, there's been over 15.2 million people that have been hired. There's only 4 states in the country that are actually bigger than that. It's pretty incredible. Bigger than Illinois, bigger than Ohio, Michigan. I mean, the numbers, it's staggering. In fact, okay, so now your point about, so now do you actually put fiscal on top of that? No, it's historic, or I'd say it's a historic dynamic. However, you still have an economy that still has slack in it. You still have an economy that can operate at a higher level. You talk about if you start bringing down taxes, and we were talking about Japan earlier, what is one of the key tenets of what Japan has done? Bring down their corporate tax to try and induce corporate behavior for corporates to locate in Japan. We are at the highest tax bracket in the world, 39% when you include state and local. If you talk about what President-elect Trump has said, 15% tax, and then you take state and local, so let's say we're down to 22% tax. It's a big deal. It's a big deal. So you're putting on what has been a vibrant, I would argue, pretty good economy, vibrant jobs market, but one big thing. All the jobs, virtually all the jobs have been service sector jobs. In the last 3 years, 4 years, 5 years, almost all service sector. If you can get the goods, the manufacturing sector, which is part of what he's talking about, if you get that moving, then you're talking about you can take a different leg up in terms of the economy.
I'm curious, though, will those goods-producing sectors hire people, or will they buy stuff? And when I say stuff, I mean machines to make their products, because we've already seen this big automation wave. Totally. So what's to say they won't just use the money for that?
So it's a great point. So think about what's going to happen. Think about what's happened in the last 2 or 3 years. What companies have been doing? They've been borrowing, buy back your stock. Borrow, buy back your stock. Now, you take some of that, and the borrow is a bit tougher because the rates are higher. Maybe you're going to take some of the tax shield off because of it. Maybe interest deduction comes off, et cetera. So now what happens? How do I grow my top line? I can't improve my earnings by borrow, buy back stock, my return on equity. Okay, so I've got to grow my top line revenue. So it means I spend on capital expenditure. Some of those, what would be jobs, clearly go to automation and to robotics. But you can see a capital expenditure growth that will lead to some more jobs, but it'll also can lead to a velocity into the economy. You start spending on CapEx, those vendors who supply the parts, now they're starting to spend, et cetera. There's definitely a momentum that can come to that.
BlackRock's Rick Reader earlier on Bloomberg Daybreak Americas.
And later today, Eric Schatzker will have an interview with the Bank of Mexico governor and incoming head of the Bank of International Settlements, Agustin Carstens. Carstens just announcing his departure from the central bank yesterday. We broke that on this show, of course. Catch that interview live at 2 p.m. Eastern, 7 p.m. London time. This is Bloomberg. Live from London and New York, I'm Naira Chahich, counting you down to the European close.
And I'm Bonnie Quinn. This is Bloomberg. It is time now for our latest Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. Ford is recalling 680,000 cars, most of them North America. There are potential seatbelt problems in some versions of the Ford Fusion and Mondeo and the Lincoln MKZ. Ford says there have been 2 accidents and 2 injuries linked to the problem. Citigroup borrowed this week in a debt market that it has avoided for the last 2 years. The bank sold around $2.5 billion worth of bonds backed by customers' credit card balances. That's according to a person familiar with the matter. Last year, Citi sold longer-term unsecured debt to meet a Federal Reserve regulatory requirement. And that is your Bloomberg Business Flash. Naira.
Bonnie, let's take a look where European markets are trading as we head for the close of equity trading. We're seeing downward pressure on stocks. The Stoxx 600 down 0.3%, on track for its first weekly decline in a month. Euro Stoxx volatility rising as well. The FTSE 100 off by 0.1%, CAC 40 off by 0.5%. DAX pretty much unchanged. Of course, a lot of focus on Italy as well and what the FTSE MIB is doing. It's actually on track for its best weekly performance among developed markets. Let's look at the bond markets, though, because we're seeing some calm ahead of that Italian referendum with 10-year yields coming down. You can see by 15 basis points there in Italy, also coming down 9 basis points on the 10-year Bund yield. And in the FX markets, a little bit of dollar weakness after that jobs report. How is that playing out with the crosses? Stronger sterling and stronger euro. This is Bloomberg. Live from London and New York, this is the European Close. I'm Naira Chehich with Vonnie Quinn. Now, stocks finishing up the day in European trading. Let's take you through all of the market action today. Big day with, of course, US jobs data out earlier. And we're looking ahead to the Italian referendum this weekend and the Austrian presidential election. With all that in mind, looking how equities are finishing up. So we were seeing downward pressure earlier, but now Italy's FTSE MIB pretty much unchanged. Germany's DAX unchanged as well. The FTSE MIB, in fact, on track for its best weekly performance among developed markets, despite concerns, of course, around the Italian referendum on the weekend. Elsewhere, you can see still some downward pressure in Spain and Portugal. So a little bit of a skew to the downside, but some of those markets unchanged. We're seeing a little bit of a pullback in the dollar in the FX space, and the impact that that's having is stronger sterling, up 0.7%, 126.76. Euro pretty much unchanged, 106.71 there. In the fixed income space, we're seeing yields coming down. Italy's 10-year yield down 15 basis points. The German 10-year Bund yield down almost 9 basis points after that 10-year yield had its worst day this year yesterday in terms of how high it jumped. And then CDS coming down as well in Italy. In the commodity space, we're seeing a bit of downward pressure on metals. Brent crude up 0.4%, $54.14 a barrel, on course for its best week since 2009. If we take a look at how we're performing across industry sectors, so overall the stock 600 down, on track for its first weekly decline in a month. In fact, we're seeing more industry groups losing than gaining. IT and financials leading the losses, and we are seeing downward pressure on energy stocks despite the crude price holding up today. Real estate outperforming. If we take a look at volatility, though, so as stocks have been coming down today, we've been seeing volatility go up somewhat on the VSTOXX index, and in fact it's set for its highest level since Trump's win. Not only that, European stock volatility near its highest since August versus the US. And then finally, I wanted to look at the euro, because yes, the euro is a little bit unchanged at the moment, but it is heading for its first weekly gain in a month. Vonnie?
Naira, I'm looking at CMM, country market movers, and it's fascinating today because there's a whole lot of risk mix, I think. You can see the buying in US equities, you know, not substantial, but definitely in the green, as well as treasuries. And partially it's because of what we saw this morning with the jobs data here in the US. It was good enough for the momentum to continue with the US labor market, but also the idea that inflation might be coming down the pike in the not too distant near term is also infecting markets a little bit, and of course the Federal Reserve rate hike. So let's take a closer look. You're seeing a little bit of a reversal from what we saw with things like financials and semiconductors yesterday. Semis are up, and that's helping the S&P to about a 1/4 point gain today. The dollar index, it's up about 4% since the US election, but it's consolidating this week, as we've seen, a little bit lower relative to certain other currencies. The Bloomberg dollar index is relative to 10 other currencies, and today we're again seeing the commodity currencies and the krona appreciating, as well as the British pound trading very close to 127 now. We're going to be taking a look at rates in a moment, but as you can see, we are seeing more buying of US treasuries, and that 10-year there is around about 2.38%. So just off its highs of the week, but nevertheless still pretty high. So let's take a look at our second board. The VIX was below 12 earlier this morning. It's now just below 13.5, so a little movement there. The dollar index is below 101. Remember, it had been above 101 for a sustained period of time, and that is DXY in this case. So the euro and the yen have much more weighting in that. And again, as you can see, the yen trading just below 13. The 30-year yield has come off its highs of the week, but still mortgage holders will be watching that very closely. Let's check in now on the Bloomberg First Word News. We want to go to our newsroom in London, and Sebastian.
Thanks, Vonnie. Russia is accusing foreign spy agencies of getting ready to launch cyber attacks on banks, maybe as soon as Monday. The successor to the Soviet-era KGB, the Federal Security Service, says the attackers plan to use servers based in the Netherlands that belong to a Ukrainian company. That company says it hasn't been contacted by law enforcement. Meanwhile, Russian emergencies are searching near Mongolia for the wreckage of a cargo spaceship that crashed minutes after launch. They're using drones to search for fragments of the unmanned Progress MSO-4 craft. It was the third failed Progress launch since 2011. Former Secretary of State Henry Kissinger is in a familiar position. He's again shuttling between the US and China to diffuse tensions. Kissinger met today in Beijing with China's President Xi Jinping. Xi is trying to figure out how much of President-elect Donald Trump's China bashing will follow him to the White House. Kissinger met with Trump 2 weeks. Meanwhile, Trump has named Blackstone Group CEO Steve Schwarzman to chair his President's Strategic and Policy Forum. The forum will be made up of business leaders who will advise the White House on how government policy affects growth, job creation and productivities. Other CEOs who are members include Mary Barra of General Motors, Jamie Dimon of JP Morgan and Disney's Bob Iger. Global news, 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Sebastian Sarnik, and this is Bloomberg. Vonnie.
Sebastian, thank you. Well, we did get a big mixed picture of the U.S. labour market this morning. U.S. employers adding 178,000 jobs in November. And the jobs rate tumbling to a 9-year low, 4.6% now, which is below the Federal Reserve's idea of full employment. But wages declining. The data comes ahead of this month's Fed rate decision, where the probability of a hike remains at 100%. Joining us now is Priya Misra, head of global rate strategy at TD Securities. And I want to just make that more clear. Average hourly earnings month over month declined 0.1%. So it's not that they're declining overall. They did increase 2.5% year over year, which is a slowdown in the increase or in the pace, let's say, but they are still increasing. Right. Are they increasing enough for the Federal Reserve to be able to go with a rate hike now and another one soon?
We think so, yes. So in our view, the data threshold for the U.S. has actually been met from the Fed standpoint. So today's report, it was marginally weaker than what we were looking for, but nothing significant. We think the Fed can hike in December. We think they'll continue to highlight 2 hikes next year. I think the big question for the market is how much more than 2 hikes? And I think this report does not make the Fed eager to suggest more than 2 hikes next year. I think the question is, do we get significant fiscal stimulus? Do we get a pickup in inflation next year with all the fiscal stimulus that the Fed might suggest more hikes? But the market's well priced for December, as you noted. The market's also well priced for potentially 2 hikes next year. So I think the front end of the yield curve can actually stabilize here. And, we actually have to figure out how much fiscal stimulus we get, what the growth impact will be for the market to take the next leg in terms of Fed expectations.
Priya, let me stop you for 2 seconds. I just want to give a breaking headline because we have got that decision now from S&P on South Africa and its rates. South Africa affirmed by S&P, outlook negative, and this is what investors were a little bit fearful of, that S&P would change the rating on South Africa. It's saying that it sees the financing need beyond expectations, that has risen quite substantially, and that gross debt in 2019 will be 54% of GDP. And I'm just going to take a quick look at what the Rand is doing off the back of that decision. And the Rand is now about 0.9% stronger, so clearly a little bit of relief in currency markets, at least, on that decision. Priya Misra, head of global rates strategy at TD Securities, is with us now.
Yes, indeed. Priya, I just wanted to pick you up on that point about the Fed after the jobs report, because we had Rick Reeder from BlackRock speaking earlier and saying the Fed has now kind of gone into a bit of a back seat for markets. Would you agree? And if so, how do you invest with so much uncertainty around policy?
Absolutely agree with you. I think the market is, in fact, if you look at the price action over the last month, the entire increase in rates has largely been led by the long end, which tells you it's not about Fed expectations. I think the Fed, with all the uncertainty around fiscal policy, is going to wait to see what plans actually shape up. But the market's forward-looking. So rather than take a view on the Fed, I think the market's going to look at inflation risk premium, risk premium out the curve, which is why the long end is where our view is that that's where you can have higher conviction. The Fed is almost going to take their outlook, they're very extremely outlook dependent, so they will need some of that uncertainty to go away. But the market has to position. We're seeing equities rise, we're seeing inflation expectations rise, and I think that's why the long end of the curve has been moving higher in yield. So I agree, it's not about the Fed. Now, we do have significant event risk. In fact, I would argue that the ECB meeting next week might be more important for the market than the Fed meeting, because that's where it's not very clear what the market's pricing in. Draghi has not been super clear, is this the time to start tapering? And I think if you do get a signal from him next week around tapering, I think the long end of the curve has a lot more room in terms of how much rates can rise.
On that point about the ECB, let me take you to this chart that I've got here, which I know you've been looking at as well. It's the 10-year Treasury Bund yield spread. That spread at its highest since 1989. Where does it go from here, Priya?
So this is a spread that over the last 2 years, every time it got high, I have faded. And as much as I'd like to fade it, and it's been a great strategy. Right now, I'm not sure, even though it's at all-time highs, that this is the time to start fading it. And the main reason for that is the two ends of that spread are both moving independently in opposite direction. Bunds are highly bid here because of the Italian referendum. We've got the Austrian election. We've got a lot of elections next year. So it's hard for me to see how bunds can back up a whole lot with all that political risk. Treasuries, on the other hand, are still pricing in this Trump effect. I'm not sure that the Trump effect is done yet for the bond market. So I think the spread can still widen. When we're getting closer to 250, I think you'll be at levels where we think that the Treasury move is done, and that's potentially a level where you can look at that spread to tighten.
You don't think the Trump effect is...
What level? Sorry, Vonnie, I just wanted to know at what level you think the Treasury move is done.
So our view is 275 would be fair value. Just given that the market tends to overdo things, you've got convexity hedging, you can get to 275, 3%. I'm also going to watch the dollar. If the dollar strengthens a lot, then rates don't rise as much. But something in that zone, I think, is actually fair. So at that point, you can potentially start thinking that that spread is sort of done in terms of widening.
If you look at break-evens, what are they telling you, Priya? If you look into my Bloomberg, you'll see that we're at, what, 1.97 right now. So,
right.
Quite a lot lower than the 10-year.
True, but I think what the market's struggling with is fiscal stimulus with the economy potentially at full employment potentially results in a significant amount of inflation. We've actually never had fiscal stimulus when the economy is doing fine. If you look at the Bush tax cuts 2001, it was during the recession. The 2009 stimulus package was right after a pretty significant recession. This time we're talking about potentially 3-4 percentage points deficit to GDP increase. That should move inflation expectations higher. This is outside of the fact that the base effects anyway move inflation higher. So I think what's driving long-end treasuries is the same thing that's driving break-evens, which is high inflation risk premium. At 2%, we're at a pretty high level for the year, for the last couple of years, but I think we're in a paradigm shift here. I think inflation risk premiums should be positive, not negative. So we're arguing for these break-evens to at least get to 2.25, potentially even 2.5, especially if the Fed looks like they're not responding. And I think the Fed...
Would that be all in one go? Would that be a major sort of repricing in one move?
It probably could be. I think particularly if the Fed in December suggests that they're not talking about sooner hikes. So there'll be this fear, I think, in investors' mind that the Fed might be behind the curve. And I don't think the Fed will be ultimately, but they're not going to jump the gun here and talk about hiking sooner. Because there's a lot of uncertainty. Do we get protectionism or do we get fiscal stimulus? What combination of the two? So if the Fed looks like, well, we're only going to hike twice next year, I think the long end is going to get very nervous around inflation. So break-evens is one way that you can sort of hedge against the sell-off in the Treasury market in the long end.
Priya Misra, thank you for coming into the studio. That's Priya Misra, Head of Global Rates at TD Securities.
Always great to have you with us, Priya. Now, coming up, Austrians will vote in their next leader on Sunday, knowing that whatever decision they make, 70 years of post-war political order will be upended. This is Bloomberg. Live from London and New York, I'm Naira Chehich with Vonnie Quinn. This is the European close on Bloomberg Markets. Time now for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. 2 days after pledging to cut oil production, Russia is reporting that output is close to a post-Soviet record. Russia pumped an average 11.2 million barrels a day last month. The country's told OPEC it would join its cutback and reduce output by 1.2 million barrels. Russia is the world's largest energy exporter. President Obama is poised to prevent a Chinese company from buying Germany's Extron on national security grounds. That's according to people familiar with the matter. Extron makes semiconductor equipment that could have military applications. The company employs about 100 people in the US, where it generates 20% of its sales. Mercedes-Benz is on the verge of becoming the best-selling luxury car brand in the US. Mercedes was on top of the sales race again last month. Sales of its GLC sports utility vehicle more than tripled. BMW has been the luxury car sales leader in the US the last 2 years. And that's the latest business flash. Now, on Sunday, Austrians will elect their new leader, upending 70 years of post-war political order. On one side is Norbert Hofer of the Eurosceptic anti-immigrant Freedom Party. He's facing the Green Party's Alexander Van der Bellen. Both are outside the ruling Social Democratic and Austrian People's Parties that have headed Austria for 7 decades. Joining us now is Bloomberg's Alan Crawford, who covers European governments, and he joins us from Berlin. Alan, just outline for us the significance of this vote.
Well, Austria, in common with Germany, the presidential post is actually somewhat symbolic. The real power is held by the Chancellor. But nevertheless, this is a very unusual election because, as you mentioned in the introduction there, the two main establishment parties who've governed the country since the war, they were both knocked out of this election at the initial round, and so voters are faced with a very stark choice of extremes, essentially, of a former Green Party leader who's running as an independent, who's very pro-EU, has been supportive of the policy of accepting refugees, and on the other hand, a far-right party that's anti-EU, is Eurosceptic, and wants to completely overhaul refugee policy. So it's a stark choice.
A stark choice indeed. Do we have any signs of which way the vote's going to go, Alan, and what it would mean for the rest of Europe?
On the first point, it's genuinely too close to call. Insofar as we can trust opinion polls these days, the latest polls, they were tied. One showed Hofer ahead, and the previous day it showed Van der Bellen ahead. So we simply don't know. And as far as the rest of Europe, this is really a barometer for how strong populist sentiment is in Western Europe. So, of course, combined with the Italian vote, it will be very closely watched.
Indeed, and we've talked a lot about the Italian vote all this hour. Of course, another country to focus on today is France. Just tell us what we've learned today and this week.
The field is becoming clearer now for the elections which come next April and May. We learned this week that the Republican candidate will be François Fillon, who's from the Conservative Republican Party. He calls himself a Thatcherite in the model of Margaret Thatcher. So a reformist conservative. And on the other hand, last night, François Hollande, the sitting president, he announced that, surprisingly, that he will not run next year, and that's the first time that has happened. A sitting president in France hasn't gone for a second term in more than 50 years. So it's starting to become a little bit clearer what will happen, but at the same time the polls, again with the usual caveats, the polls suggest that it would be François Fillon against Marine Le Pen of the National Front going to the second round.
Bloomberg's Alan Crawford in Berlin for us, breaking down the latest news on France and looking ahead to the Austrian presidential election. Now, coming up in Battle of the Charts, although small caps have been a big winner since the election, investors are starting to brace for declines, and we have just the chart to prove it. This is Bloomberg.
Time now for our global battle of the charts, where we took a look at some of the most telling charts of the day and decided to present them to you, our viewers. You can always access these charts on the Bloomberg by running the function featured at the bottom of your screen. And kicking things off here in New York is stocks reporter Joe Scioli, but he's so much more than just a stocks reporter, right, Joe?
Yeah, so today I'm going to be talking about the Russell 2000, or small caps, and they actually just got done with their best month in 16 years versus the S&P 500, and you can see that they're outlined in the red box, and really it's been nothing but positive for small caps since the election, whether it's the strong dollar or whether it's some of Trump's policies. People have really been favoring that, and hence the outperformance. However, the bottom chart really tells the story here. It shows the VIX for the Russell 2000 versus the VIX for the S&P 500, and you'll see that that's the highest since 2014. So really what that means is that people are nervous about these gains in the Russell. Maybe it's gone too far. Maybe it's time to sell off, take some profit. So we're definitely seeing a little bit of nervousness there. And that's interesting because the VIX usually trades in the opposite direction of the underlying index about 80% of the time. So you'd think that the Russell 2000 VIX would be lower than that, but it's not, as you can see there. And so that's very troubling for people that are maybe holding on to the Russell 2000 shares, and maybe it's time to sell. And you can see that on the terminal at #BTV5214.
Fine chart and fine presentation, Joe Scioli. All right, Nero, what have you got?
Well, my chart focuses on Italy, Vonnie. Of course, we've been talking about it a lot in the show. And we've been talking about the fact that until today, we really were seeing the markets pricing in a no vote in the referendum on the weekend. Some people, like, for example, Kevin Lilly of Old Mutual Global Investors, say everyone's preparing for the worst. We could see a relief bounce in Italian stocks on Monday because the positioning has been overwhelmingly bearish. I mean, earlier I showed a chart that traders basically have been paying the most in more than 2 years to hedge against swings in the FTSE MIB versus the Eurostoxx 50 index. We've also been talking about the fact that there's a calm in the Italian bond markets today ahead of that referendum, and we're seeing yields coming down and that premium, that spread with the Bund 10-year yield coming down as well. So this chart shows the FTSE MIB earnings yield versus 10-year debt this year. And very simply, what it shows is that Italian stocks are looking the least attractive this year versus bonds. It's a simple chart, but I just thought it was food for thought ahead of everything that we've been discussing with Italy. And you can see my chart on the Bloomberg at #BTV4240.
And the market is definitely one way of listening to the prevailing opinion out there, right, Nera? If you listen to what the market's doing and follow it, I think that wins today, this Friday. Only, Joe, because we're going to be yes, you win the. I feel like we need to bring out a cake or something, Nera. So I need to give you something across the water, but can't, unfortunately. Only, Joe, because we're going to be watching the outcome of the referendum on Sunday.
There's always next time.
I love the attitude. See, he's great. All right. Congratulations to Nera. And I also want to let you know that today, a big interview that you won't want to miss, which also has an impact on all of these things that we're talking about. Our Bloomberg editor-in-chief, John Mickleswaite, will sit down with IMF Managing Director Christine Lagarde. It's a wide-ranging interview on the global economy and more. 1 p.m. Eastern, 6 p.m. London time, Bloomberg Television, Radio and Bloomberg.com. It's noon in New York, 5 p.m. in London, and 1 a.m. in Hong Kong. I'm Bonnie Quinn.
And I'm David Gura. Welcome to Bloomberg Markets. From Bloomberg's world headquarters in New York, we're covering stories from Washington to London and Beijing this hour. Here's what we're watching. A mixed picture for the U.S. jobs report. 178,000 jobs added in November. Hiring picking up, but wages unexpectedly declining. So what does that report mean for the Fed and for the markets? President-elect Donald Trump's team continues to meet with Goldman Sachs President Gary Cohn. Is he planning a move from Wall Street to Washington? Plus, an exclusive interview with Ireland's Prime Minister, Enda Kenny. He'll tell us why he thinks the relationship between Europe and the U.S. is, in his words, enormously important. We're halfway into the trading day on this jobs day, and Abigail Doolittle is here with the latest. Abigail.
Well, David, we are looking at largely unchanged markets for the U.S. averages. We have the Dow ever so slightly lower, the S&P 500 and the NASDAQ up slightly. Tired trading with these unchanged percentages for the major averages, telling us to some degree that non-farm payroll report is being viewed as somewhat of a non-factor by investors. As for the weekly performance, though, it's a big switch up from this. We're looking at the Dow having the only weekly gain on the week. The S&P 500 is down more than 0.5% on the week, whereas the tech-heavy NASDAQ is down the most, down about 2.5%. And when we take a look at sector performance on the week, it helps to explain that huge divergence in weekly performance. Helping this week, the energy complex and the banks. Energy, of course, getting a boost from OPEC's decision to cut supply for the first time in 8 years, helping oil have its best week since August of 2015. The financials getting a nice tailwind from rates trading higher, and it looks like consumer discretionary and tech down so much to some degree funded this, so a bit of a sector rotation. In fact, Scott Bauer at Trading Advantage yesterday told our team that this is the biggest rotation sector-wise and asset class-wise that he can remember in his career. And from an asset class standpoint, it's really very interesting. When we go into the Bloomberg and we take a look at G#BTV 5205, this is a longer-term chart of the Bloomberg Barclays Global Aggregate Bond Index. And in the month of November, $1.7 trillion fell out of the global bond market, the biggest drop on record going back to 1990. Interestingly, though, it appears that much of this money went into U.S. stocks. When we take a look at an overall market cap look at U.S. stocks, we see that in the month of November, $1 trillion went into U.S. stocks. What's interesting, though, there, Vonnie and David, we have a roughly $700 billion gap. As for where that money went, we did see a big move up in the industrial metals in the month of November, but there's also a strong possibility that there could be a lot of money on the sidelines in cash, especially ahead of the Fed decision on December 14th.
All right, Abigail, I love that headline, $1 trillion baby. Thank you. Let's check in now on the Bloomberg First Word News this afternoon. Emma Chandra has more from our newsroom.
Thank you, Vonnie. Supporters of President-elect Donald Trump have filed a suit to stop the election recount in Wisconsin. The suit claims the recount threatens the due process of people who voted for Trump. Trump won Wisconsin. The recount was requested by Green Party candidate Jill Stein. Meanwhile, a top aide to President-elect Donald Trump says law enforcement officials might continue investigations into Hillary Clinton's private email. Kellyanne Conway said Mr. Trump still prefers not to pursue a case against Clinton, but she says law enforcement officials and Congress may take a look at it. Two shooters unleashed terror on San Bernardino a year ago, and county employees will remember their fallen colleagues with a moment of silence today. Later, community members will gather to remember the 14 people killed and 22 wounded, with speeches from religious leaders and law enforcement. Police will hold a 14-mile memorial bicycle ride that will end near the site of the shooting. And U.S. Secretary of State John Kerry paid a visit to Pope Francis at the Vatican. The two men met in the Pope's study. Kerry also met with Russian Foreign Minister Sergei Lavrov. They are in Rome to participate in a Mediterranean dialogue summit on security. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg. David.
Emma, thank you very much. Let's get back to our big story of the day, jobs data from the Labor Department and how they could influence the Federal Reserve's interest rate decision. Joining us now is Chris Heisey, CIO of Global Wealth and Investment Management at Bank of America. Great to have you with us here today. You saw the number, you saw the headline numbers, you digged into the report. What was the thing that stood out to you the most here? Was it wages? Was it the unemployment rate?
You know, the unemployment rate's driven more by the participation rate in this particular cycle. So it really was the wages. And of course, the extrapolation now is that, wow, wage growth is slowing down. That means inflation might slow down a little bit. That means maybe December is still in play, but not as much. And I would simply say that those are very noisy numbers. And much of what would have come through in this month came through last month. And the trend is up in wages. The trend is up in inflation. The Federal Reserve knows this. It's time to normalize interest rates.
Larry Summers with this idea of secular stagnation, but you say we're actually moving from secular stagnation into cyclical growth now. What gives you the absolute conviction, and what growth rate do we get to?
You know, part of it is there's nowhere else to go. We've been in the monetary regime we've been in now for many, many years. It worked for a while after the credit crisis. It was solely designed to stabilize asset prices. It did its job. And then all of a sudden it got very tired. And then once you get to negative interest rates in 1/3 of the world, I would venture to say that that's a bottoming in rates. There's a lot of talk, is the bond bull market over? Bonds and fixed income are very different than rates, so we can the time. But as it relates to secular stagnation moving towards fiscal reflation, fiscal stimulus is vastly needed around the world. We know that. Less austerity, less regulations needed overall. And the only way to really combat all of that and combat the secular stagnation is to move there. The difficult part is everyone wants it tomorrow, and everyone wants to see that growth come in the first half of next year. The reality is it's second half, and more or less, really 2018, where the growth will start to show up. But equities and today, managing money, it's a much greater and faster accelerated discounting mechanism probably than ever before. So we're seeing a lot of that now.
We just saw the 10-year there. We've seen movement in bonds this morning since that report came out. But let's take a broader view of how bonds have been doing. Do you call it a rout? What do you make of the moves we've been seeing?
Well, it's certainly a little bit of a stampede. That buffalo is certainly stampeding down. It'll probably turn into a little bit of a roam later on across the prairie. And the reason is because so many people across the world, particularly the institutional side of the business, was so over-allocated to long-dated fixed income for obvious reasons. Once you get overexposed, any sign that that's not necessarily the best place to be, you start to see that stampede. This is phase one. Phase one happens to be within money that's already allocated, and then you're going to see phase 2 and 3 next year, which is new money into the marketplace.
Where does it go?
Well, it should be going to pro-equities in terms of a pro-cyclical rally. If you get higher nominal growth, you get a little tick up in the yield curve. You're going to look at more cyclical value areas. It's already telling us that, but they're so under-owned. Those phases should continue to come through, and as new money comes in, it's pro-equity, pro-value, pro-areas that have not participated in this move.
Help us understand the interplay here with the Fed Reserve, the decision they're facing here in a couple weeks. I've got WRP go here on the terminal. Of course, you can see the 100% probability there of a hike, which it's been there for a couple of weeks now. Are you looking ahead to February, and what are you going to be listening for from Janet Yellen when she speaks after the announcement of the rate decision in a couple weeks' time?
We have to check and see what words have changed in the communication, and if words are more or less, we're very much looking at inflation now, that's a change.
Do you expect commentary on fiscal stimulus in light of the election?
Within that communication coming from the Fed, probably not. That will likely come afterwards as we move towards the February meeting in the terms of the speeches that get made. I would say this. The Federal Reserve has basically a tough go here. They know they need to normalize. The window opens and closes so quickly. The window is now open. So the question is will the window remain open for February? Probably not. And the reason is they do want to take their time. In order for this to work, when I say work, in order for growth to get going and remain sustainable, you have to have somewhat loose fiscal, and you have to maintain somewhat loose monetary until you start to see inflation get up to levels that become concerning.
Is it still an interesting environment domestically for investors, or is it time to really just look abroad and, you know, look at some of the emerging markets that have seen a major sell-off?
Great point. You almost always swing the other way too quickly. Technology and the emerging markets are two classic examples of swinging the other way. Those were areas that actually vastly outperformed this year. The emerging markets for the first time in many years, particularly the 6-month period up till the election. And of course the knee-jerk reaction is higher dollar, higher rates, bad for emerging markets, particularly with their dollar liabilities. And then if you look at technology, they're a source of funds to feed the under-ownership of things like banks and other value areas. I think they've gone too far. The jury's still out on emerging markets, however, though. You can build a really good upside case, and you could also build a downside case in terms of what is the eventual potential policy impact out there. So a neutral to overweight position emerging markets, given where they've fallen already, is probably appropriate. And then technology, it's gone too far.
All right, you got UK, US, Italy this weekend. How are you approaching that vote in light of what we've seen those last two?
When you're managing portfolios and you're looking across the world and you have to put money to work and you don't always have to be fully allocated, you have to make certain regional decisions. And right now, the regional decision around the world still seems to be more like a barbell. You go for growth in the emerging markets, you look at the United States for high quality areas, and in Europe especially, the political cloud that's going there, we just don't know. We can hypothesize about where they're going, but investors don't make decisions on hypotheses in this type of cycle. They have to wait for confirmation. We're going to need to see that all play out. I would simply say when you're putting global money to work, Japan is an easier story to grab onto right now in terms of cyclical value. And Europe is going to take a little bit of a backseat. Eventually we'll get through that, and I think the surprises economically in a weird way will be in Europe.
But we're really on our way to Dow 20,000 though, I mean, given what you're saying.
Yeah. We're on our way to Dow 20,000. We're on our way to S&P 2,400 next year.
There you go. Chris, thank you very much. Appreciate it. As always, it's Chris Heisey, Bank of America's CIO of Global Wealth and Investment Management, joining us here in New York.
Coming up, the Trump transition team is said to have scheduled a meeting with Goldman Sachs President and COO Gary Cohn this weekend. We'll have the latest on what job he may be up for. This is Bloomberg. This is Bloomberg Markets. I'm Bonnie Quinn.
And I'm David Gura. Time now for the Bloomberg Business Flash. Look at some of the biggest business stories in the news right now. Pandora Media is now open to selling itself, and it's willing to engage in talks with suitor SiriusXM. That's according to CNBC, which says Sirius is expected to pursue a deal to acquire Pandora. A Pandora spokeswoman declined to comment. Sirius did not immediately respond to requests for comment from Bloomberg News, and shares of Pandora surging on the news of that deal. The International Association of Athletics Federations, track and field's governing body, says it will end its commercial agreement with sponsor Adidas this year, 3 years early. The original 11-year partnership deal, which began in 2008, had granted the German sports apparel maker global sponsorship rights until 2019. And the fashion industry is poised to recover in 2017 after one of its toughest years on record. A report from consulting firm McKinsey predicts overall industry sales will rise as much as 3.5%. The reasons for that? An improving global economy and restructuring measures by brands like Burberry and Ralph Lauren. And that is your Bloomberg Business Flash. Funny.
Well, David, let's turn to politics and President-elect Donald Trump announcing last night that he has picked retired Marine Corps General James Mattis for Secretary of Defense. The Trump transition team will continue to be busy this weekend. They're said to be meeting with Goldman Sachs President Gary Cohn. But it's not yet clear exactly which job Cohn could be up for. Joining us is Bloomberg politics reporter Kevin Cirilli. So much to talk about.
So much to talk about. I mean.
It's hard to know where to start, but let's start with Gary Cohn.
Yes.
There's so much he could do, right? But what would he want to do?
Well, that's the million-dollar question right now, particularly after, of course, Steven Mnuchin being named to the Treasury Secretary position, already facing some progressive backlash, mind you. But the Goldman Sachs issue, some people within Trump's political orbit are a bit concerned that perhaps Goldman is having too much of an influence within this new administration.
How many now? How many already appointed?
At least 2 or 3, as far as I'm concerned. But with this meeting in particular, I think that it shows that that President-elect Trump is really valuing some of these business folks. And just last night in Cincinnati at his rally, he said, you know, why is everybody criticizing folks with business experience that worked for him on the campaign trail? Will it work for him in Senate confirmations? We don't know yet.
Quite an event last night. The viewer would be forgiven for being mistaken, thinking that was November 1st and not December 1st when he's giving this event in Ohio. He allows, after criticizing the media, that he intends to nominate General Mattis to be his Secretary of Defense. How tricky is it going to be to get him approved in light of the fact there is this rule on the books that you have to be out of uniform for 7 years before taking a civilian position?
Well, if there's one thing Donald Trump's good at, it's bending those political rules. But what was also interesting about last night was that this was an announcement that he wanted to save until Monday, that his advisors wanted to
couldn't resist
closer.
Though.
He could not resist. It was like he had a lot he needed to get off of his chest. He talked about the protesters, which he said didn't even vote for him or didn't even vote in the election. He talked about, of course, announcing Mad Dog Mattis, and he also talked about flag burning. But the overarching theme was that he wanted to unify the country. So it was classic Trump in many ways, and I think a speech that stood out over the past couple of months.
So, Kevin, we have a pretty classic hawkish cabinet so far, assuming that they all get through Senate confirmation hearings and get nominated to their posts. Is there any post left that maybe might balance out this hawkishness in any way?
I don't really think so, and that's a great question, because what's a point that I would make is that Donald Trump ran on populist rhetoric, and yet the positions that he's appointing on the economy if you look at their past, have adapted a more globalist type of financial policy. And so I think I'm intrigued to see what happens with the Fed board, especially that key Federal Reserve Vice President for Supervision. Of course, that hasn't been filled in quite some time. But a lot of the names that are being discussed, whether it's Honig at the FDI, Honig or some of these other folks, have really adapted a more globalist economic worldview.
Every 4 years, the Kennedy School at Harvard convenes this group of reporters, strategists, managers from the campaign. They get together to talk about what's happened. Yesterday, that happened in Cambridge. It was, by all accounts, an extraordinary meeting. A lot of tense words between Kellyanne Conway, Robbie Mook, Jennifer Palmieri, members of the Clinton camp as well. In light of that, in light of what we heard from Donald Trump last night, it seems like the campaign itself is not a far-off memory for a lot of people in these inner circles.
It really isn't, and I think that it's going to take, again, quite some time. But, you know, there's still about a month and a half until he'll be sworn in, and especially when you look at the popular vote. This is someone who lost the popular vote by about 2.5 million votes, but he did win the Midwest. And so I think that both sides and both political orbits and the sources that I speak with acknowledge that this is a very divisive time and polarizing time for our country. Hillary Clinton has made frequent appearances. She's not really signaling that she's going to disappear.
Taking a lot of hikes in the woods.
And yesterday she was partying with Katy Perry at a charity event. So, you know, it's a very divisive time.
Kevin, you're in D.C. typically,
yes,
except for today, obviously. I don't want to ask the question, what is the mood like? But I mean, people are moving out of D.C. and people are moving in. What is the mood like?
I was talking with a top banking lobbyist earlier this week, and what this lobbyist told me was this is unprecedented, because the banks and the financial institutions, they knew exactly what Hillary Clinton's financial legislative agenda would be like. there's a lot of uncertainty with what President-elect Trump's agenda will be. There weren't that many details. But I can tell you this, if you look at the market reaction, if you look at some of these names, if you look at the meetings he's taking, Cohn this weekend, Mnuchin being nominated, that has provided a lot of certainty for these folks.
Our thanks to Kevin Cirilli, Bloomberg Politics.
Still ahead, shares of Extron are lower on reports that President Obama may block a takeover by a Chinese company because of national security concerns. We'll have the latest on that next. This is Bloomberg.
This is Bloomberg Markets. I'm Vonnie Quinn.
And I'm David Gurr. Some technology news now. President Obama expected to block a Chinese company from buying semiconductor equipment supplier Extron in Germany. That's according to Bloomberg sources. If so, it would mark the third time in a quarter century that the White House has rejected an overseas buyer because of a potential security risk. For more, we are joined by Bloomberg News reporter Aaron Kirchfeld, who is with us in London. Aaron, the basics here first. Why is the Obama administration rejecting this?
So the concern here is that even though it's a German target, Extron, they build machines for semiconductor makers, they do have a business in the U.S., and they have some applications that are used in the defense industry. So CFIUS, the authority in the U.S. that looks into kind of these deals when it comes to, may have an impact on national security issues, they have raised concerns, and they have recommended that the Obama administration reject it, and we're just waiting for the government to make a final decision and announce that. So that's the concern, the exposure to U.S. defense industry.
I mean, is it a no-brainer? We're not there yet. We're not at the point where we can completely trust other countries with our defense systems. So, is there anything to question here?
Well, I think if you look at it from the German company standpoint and the Chinese buyer, the big question they have is they were willing to negotiate some kind of settlement that would have eased the defense concerns in the U.S. So, for example, they would discuss things like selling the U.S. exposure, et cetera. But I think the overall concern here is the, people in the U.S., especially in the U.S. government, are very, very sensitive about any kind of pass on from know-how to the Chinese in the semiconductor space and technology in general. We've seen some other deals that have raised concerns as well. So I think that's the big issue here. The U.S. government, this is part of a bigger worry about, IP and technology just getting transferred that, may not end up in the hands that the U.S. government wants to see.
I remember being in Shanghai and hearing from an executive from Huawei, which was trying to make inroads in the U.S. market, has been for some time. And he was detailing just how difficult the struggle had been to get that done, all of the appeals, all of the lobbying that company had done in the U.S. You mentioned CFIUS, this regulatory group that oversees deals like that one. What recourse does this company have to appeal the decision, if any?
So I don't think they have a lot of leeway here. I think when CFIUS first reviews these kind of transactions, that's when most of the work is done. So the people working on the deals, the legal teams, et cetera, they make proposals, they hold kind of negotiations behind the scenes with CFIUS and other government organizations. They propose remedies. But once CFIUS comes out with a recommendation and the U.S. government makes a decision, and if they decide to block this, this would be Obama's only second time he's done this under his administration. I think it's pretty much a done deal. So that's why after our story, which cited people familiar, came out, ICE Run shares are sharply down because investors and shareholders are assuming this deal is done, is a dead one.
And of course, now with the president-elect being Donald Trump, I mean, the received wisdom would be that it would make it even harder for China to do deals like this in the future.
That's right. I mean, we've seen all the political rhetoric coming during the campaign, and Trump was very tough on China. So I think this probably only makes things worse for Chinese investors. The interesting aspect here is, you know, Chinese companies have kind of focused more on buying in Europe, thinking that will avoid the U.S. issues. But because many of these European companies have global operations, have U.S. exposure, the U.S. government has become almost a de facto global regulator when it comes to national security issues.
Aaron, let's take a step back here. Give us a sense of what kinds of companies, Chinese companies, are interested in buying. This here in the semiconductor space, as you say. But as we see this uptick in M&A activity from China, what kinds of companies is China looking at?
Well, I think anything that is technology related or manufacturing, they've shown a lot of appetite for. But we've also seen, obviously, the biggest Chinese deal of all time was the ChemChina purchase of Syngenta. That is about food, food supply, agricultural chemicals, et cetera. That's a big one. And that just fits their strategy of wanting to kind of improve farming, et cetera, in China. So anything that fits, you know, big strategic questions in China for the future, that's what they want. But you may have seen just recently, we reported and others that the Chinese government is looking to start blocking 10 billion plus deals. Yeah. Why? I think they're a little bit concerned about too much money, too much capital leaving China, and then other companies making purchases that aren't that smart.
All right, Aaron Kirchfelder joining us from London with that market-moving story. Thank you very much.
Irish Prime Minister Enda Kenny up next. This is Bloomberg.
Live from Bloomberg's World Headquarters in New York, I'm David Gura.
And I'm Bonnie Quinn. This is Bloomberg Markets. Let's start now with the headlines on the First Word News this afternoon. We're going to go to our New York newsroom and Emma Chandra.
Thank you, Bonnie. More meetings are set today at Trump Tower as the president-elect fills out his cabinet and senior staff. Among those Donald Trump will talk to today, former Defense Secretary Robert Gates, David Malpass, founder of Encima Global, former UN Ambassador John Bolton, and Democratic Senator Heidi Heitkamp of North Dakota. This weekend, Goldman Sachs President Gary Cohn returns for a second meeting. Cohn's been mentioned as a possibility for several jobs, including budget chief. The House has approved a $611 billion defense policy bill that rejects a number of President Obama's proposals for managing the nation's military. Lawmakers passed the legislative package Friday by a wide margin, 375 to 34. The bill now goes to the Senate, where a vote is expected early next week. The legislation would prohibit closing the prison at Guantanamo Bay in Cuba and would deny the Pentagon's bid to start a new round of military base closings. The British man sentenced to life in prison for trying to detonate explosives in his shoe on a transatlantic flight says he can't afford the $250,000 fine that was also part of his sentence. The Boston Herald says Richard Reed has asked a federal judge to declare him bankrupt. Reed tried to set off the bomb on a Paris to Miami American Airlines flight in 2001. Ireland's Prime Minister says the UK's decision to leave the European Union stands in stark contrast to its history as a forward-looking player on the international stage. Enda Kenny sat down today with Bloomberg editor-in-chief John Micklethwaite and recalled his reaction to the Brexit news.
Britain was always a really important member of the European Union and was a voice for change and was a voice for a vision for the future. Obviously, the decision then in Brexit came as a shock. It's something I didn't want to see, something that I didn't want, but I have to respect because it's a democratic decision, so we get on with it.
Kenny also said the UK won't be allowed to pick and choose which aspects of the EU it wants to keep as it prepares to leave the world's biggest trading bloc. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg. Bonnie.
Emma, thanks for that update. I want to check quickly now on US stocks and how they're faring. As we head into the second half of the U.S. equity session, we see a turnaround. The Dow is now down more than 0.1%, still at 19,162, though. The S&P 500 barely holding on to a point of a gain at 2192, and the Nasdaq is just up 0.1%, so well off the lows of the day. The dollar index down about 0.33% as well. Let's get some more detail now. Abigail Doolittle is here at the markets desk.
So as you just highlighted, Vonnie, we do have the major averages here in the U.S. mixed on the day, true two on the week, but in really a reverse fashion from what you just described. As you just mentioned, the Dow is one of the three major averages down on the day. As for the week, the Dow is the only one of the major averages higher on the week, ever so slightly, but we see that the S&P 500 and the Nasdaq are both lower on the week. The Nasdaq really significantly so. This as technology weighed more so on both the S&P 500 and the Nasdaq. Now, the reason we're looking at a bit of a role reversal here, if you will, technology weighed on the week, but today we're seeing a bit of a recovery in technology. This includes Facebook, Qualcomm, and Apple. Facebook seems to be snapping back from a two-day pullback of about 5%. And in fact, JP Morgan's Doug Anmuth, he's saying that of the big internet names that he covers that are down pretty significantly since the election on a sector rotation, Facebook is the only one that's at trough level valuation. So investors may like hearing that. While Qualcomm and Apple appear to be recovering from a Digitimes report yesterday saying that Apple suppliers may be pulling back, that Apple may be pulling back on its orders from Apple suppliers. So Qualcomm, of course, is an Apple supplier, bouncing back a little bit today, and Apple appears to be doing so as well. As for what's dragging on the Dow this week, the financials. We do have the banks lower. This includes Bank of America, JP Morgan, and Citigroup. This, of course, as yields are falling back, we do have a bit of a pause in that massive spike higher. Plus, this represents a little bit of a breather for the bank sector overall. The XLF, or the financial ETF, is up more than 10% since the election. So investors, again, consolidating those gains, Bonnie.
All right, Abigail Doolittle, thanks for all of that.
All right, now more of that interview with Ireland's Prime Minister Enda Kenny. Brexit Secretary David Davis suggested this week that the UK could continue to pay into the EU budget after leaving in order to keep market access. In an exclusive interview, Bloomberg's editor-in-chief John Micklethwaite asked Kenny if the UK would be allowed to cherry-pick what it wants from the EU.
Certainly not, and that's been made clear already by many European leaders. One of the fundamental principles of participating in the European Union is that if you want access to the most developed market on the planet, that is the single market, then you must cater for those freedoms, one of which is freedom of movement of people. And there will be no concession given by Europe in that regard.
What about the timing? You've said that 2 years probably isn't enough. It's going to go on longer. If you had to make a guess about what the eventual date of the British leaving would be, what would it be?
It's impossible to say, John. You see, nobody's left the European Union before. This is the first time that a country under the treaties is actually going to leave. So you've got 50 years of regulations and directives and legislation dealing with the relationship between Europe and the United Kingdom. We joined on the same day. So to end that in a 2-year period is probably impossible. So I think that you'll have a transition period beyond the negotiations. And it's important to remember that Britain remains a member of the European Union until it has left. And that means that it accepts its responsibilities, will pay its way and will contribute as it should. It's sort of awkward in the sense that at meetings of the 28, as all the members of the European Union, you will have side meetings of the 27. We're making arrangements without formal negotiations as to the contingencies that might have to be considered. And we've a plan about that ourselves for quite some time, dealing with the particular circumstances that Ireland finds itself in.
I'm interested by those circumstances. Where do you see it in terms of positive and negatives? You know, you've obviously got the huge negative of a major trading partner separating in some ways. On the other hand, you're here talking to bankers, you're seeing a lot of people who might conceivably move jobs from London to Dublin.
I would say in my time on the European Council and from observations before that, Britain was always a really important member of the European Union and was a voice for change and was a voice for a vision for the future. Obviously the decision then in Brexit came as a shock. It's something I didn't want to see, something that I didn't want, but I have to respect because it's a democratic decision, so we get on with it. So a country leaving will be the subject now of pretty intense negotiations.
But in terms of where Ireland comes out of this, how many jobs do you think Ireland might be able to get from the City of London moving?
In every political issue like this, there are always opportunities. And we're having a stream now of inquiries from Britain about the possibility of, financial houses or banks or others moving to different locations. Ireland will compete for business, obviously, fairly and hard with other countries. An example, for instance, is the European Banking Authority and the European Medical Agency. Decisions have been made that they should move from London.
And you'd like to get them?
Well, we will compete for them, and obviously we offer a particular range of attractiveness as an English-speaking country within the Eurozone, 1 hour away from London, but a country that is staying as a central part of the European Union.
I think I'm hearing your pitch.
Well, it's a pitch if you like, but obviously, you can't make the decisions for these entities or for financial houses. But what we will do in Ireland in terms of relocation is to say, we'll give you a specialist team and test us to see whether we measure up to your requirements or not. I think it's important to be able to say that what companies and what financial institutions want is certainty and clarity about that future. And when you have confusion arising from rumours and allegations, then until you get down to negotiations about what are we talking about, it's impossible to make clear outcomes and political decisions about.
You very modestly in that list of attributes didn't mention the 12.5% tax. That's also an issue, and now you have the British saying they're going to reduce their tax, and you also have the new President Trump talking about a lower tax rate.
And they're entitled to reduce their corporate tax rate. Within the European treaties, it is a matter of national competence as to what level a country wants to set its corporate tax rate at. Ours has been at 12.5% for very many years, across the entire spectrum, absolutely transparent and fully accountable. So we're not moving from that rate. Other countries can move up or down, as we could, but we won't. Some countries might have a set higher rate, but when you examine it, depending on the sector or the location, it might be much lower than what the headline rate would be.
Can I ask you one last thing on Brexit? Do you think that this perhaps sets the stage in the very long term for some kind of reunification of Ireland? You saw Northern Ireland voted to remain.
Yeah, well, Ireland's has a very particular set of circumstances here. Obviously, the northeastern portion of Ireland, Northern Ireland, arose out of the partition of the country back in the 20s after a civil war and an agreement with England. So you had a very, very difficult period over the years in some circumstances. So now, obviously, there's a devolved administration in Belfast in Stormont, operated by First Minister Foster and Deputy First Minister McGuinness and their respective parties. So we work very closely with them. Now, one element of all of that is that the peace process was brought about with the conclusion of what was known as the Good Friday Agreement 30 years ago. There have been successor agreements to that. I, as the head of government, am a co-guarantor of that internationally binding agreement. So the negotiations that will follow, irrespective of where they lead, will have to include the co-guarantorship of that agreement and what it means for the people. So what I want for them...
But that agreement also allows for the people, if they wanted to vote,
yes, it does,
on coming things together.
What it means is that it's written in there in a visionary way, if you like, that if at some time in the future, whenever that might arise, if it were to arise, the people north and south would vote to have a united Ireland, and then that's allowed under the Good Friday Agreement and its successor agreements. So the negotiations that take place at a European level will want to include recognition of that fact, which is a legally binding international agreement, and I intend to see that that applies.
You're sometimes mentioned as someone who could end up running the European Union. Do you worry that what might happen in Italy over the weekend might mean that job isn't possible?
No, obviously my focus is on achieving our priorities, which are our own economy, our jobs and trade, the peace process on the border with Northern Ireland, our relationships with the United Kingdom and the common travel area, and then our place in Europe. It's important to say, John, that when the Brexit negotiations are on and when they're concluded, that within Ireland will be the only land border within the European Union. And that's an issue that Prime Minister May and I have agreed on, that there should not be a return to that hard border of, you know, customs and customs posts and military equipment and all of that.
And that was Irish Prime Minister An Taoiseach Enda Kenny on Bloomberg Daybreak Americas this morning. You're watching Bloomberg Markets. Watching Bloomberg, I'm Bonnie Quinn.
And I'm Naira Chahich. This is your Global Business Report. US payrolls rose and the jobless rate fell in November, but the report may not be as good as it looks at first glance.
The fallout from the Brexit vote continues. A look at how it's impacting the holiday shopping season.
And in today's Quick Take, China has been on a shopping spree in the US and Europe, but regulators may be getting ready to put it to a stop. The November US jobs report was a mixed bag. Hiring picked up last month, with the economy adding 178,000 jobs, and the unemployment rate dropped to 4.6%. But some are urging caution, even in the face of a surging stock market. Here's Bill Gross speaking today to Bloomberg Television.
4.6 is a headline-grabbing number. It's getting close to the lowest numbers that we saw in the early part of the century before Lehman, I suppose. So that will be the headline. But you know, we're certainly not out of the clear. When I saw the minus 0.1 wage number and the revision, or the YOY, coming down from 2.8 to 2.5, to me it indicated that things are just not as hunky-dory as the stock market seems to think it is.
Brexit is bringing Christmas gloom for a number of Britons. According to a survey by PwC, about a quarter say their holiday spending will be affected by the country's decision to leave the European Union. The survey found that Britons will spend slightly less on Christmas gifts this year.
It is time now for our Bloomberg Quick Take, where we provide context and background on issues of interest. Corporate China has been on an unprecedented spending shopping spree, snapping up companies across the United States and Europe. But not everyone's happy about it, and now regulators are stepping in to nix deals. Here's a look at what's behind all the unease.
All of these businesses have something in common. They're now owned, part-owned, or about to be owned by Chinese companies. China's dealmakers have been buying up American and European companies at a record rate. And for the first time, China's running neck and neck with the US as the biggest buyer of overseas companies. And that's making some lawmakers very nervous. So here's the situation. In 2016, Chinese companies more than doubled the record $106 billion of deals they amassed in 2015, putting them close to the US for the most overseas deals. Among the main concerns of lawmakers is whether Chinese firms with their close ties to the Chinese government pose a national security threat. The American regulator charged with monitoring such matters has been paying particular attention to technology deals. Its involvement led to the collapse of Chinese investments in Western digital. Europe, which has no such regulator, became a more popular target than the US for Chinese deals in 2015 and 2016. China's been snapping up German companies at a rate of more than one every 2 weeks in 2016. Germany's economy minister is demanding the European Union strengthen powers to nix deals or impose conditions on outside companies. Here's the argument. Free market proponents say it's unfair that Chinese regulations make it hard for foreign companies to buy Chinese firms, but Chinese companies are much more free to shop around in other countries. They argue that China Inc. also gains an unfair advantage from easy financing provided by government-backed banks. On the other hand, one report found that Chinese takeovers had saved many American firms from bankruptcy and that most had resulted in expansion. A study in Germany drew similar conclusions. Doomsdayers warned that Chinese overseas investment could turn into a Trojan horse that introduces the country's politics and values. Critics respond, that's a Cold War mentality. Meantime, China's companies face a new uncertainty: Donald Trump.
Think of this. They take our money. They take our jobs, and we owe them $1.6 trillion.
The US regulator with the power to kill Chinese deals will be headed by Trump's Treasury Secretary.
You can read more about China and all of our quick takes at NI Quick on the Bloomberg, and that is your global business report. Head to Bloomberg.com for more stories. This is Bloomberg Markets. I'm Bonnie Quinn. Miami may be on the verge of an environmental crisis with rising tides and groundwater threatening the city. But that doesn't seem to be scaring developers away, who continue to pour billions of dollars into large projects in spite of the increasing danger of rising water levels. Joining me now to discuss is Bloomberg's James Tarmey, who wrote about these new developments in the latest Bloomberg Pursuits. James, billions of dollars pouring into Miami, but the water will possibly be pouring in the near future too.
Yes, and there's very little to do to stop it because the water is actually coming up through the ground's porous limestone as opposed to kind of what Manhattan is dealing with, which is potentially building a seawall or something along those lines. So really all Miami can do is pump out the ocean constantly, and that's actually what they've been doing with these underground parking garages.
So the new buildings that are going up, and there are many, we'll get to why on earth anyone is building in Miami or buying in Miami next if they really believe that this is happening, and it's quite clear that it is. But the new buildings, do they have any kind of architecture that's designed to get rid of water, and how long can that last?
Well, some of them do, and a lot of developers are finding that it's quite easy to just build an extra 3 feet above the ground and not actually have underground facilities such as parking garages or basements or anything along those lines. Of course, some pretty conservative studies have shown that if sea levels rise just 1 foot, then you'll have 7-foot storm surges on a regularity of every 20 years or so. So there will be extreme flooding. However, what we already see in Miami Beach is people raising roads quite right now because if you walk down Collins Avenue on Miami Beach when it's been raining or when there's a high tide, I mean, you're going to get wet.
So who's buying?
Well, that's a great question. I think people who are simultaneously very optimistic and people who assume that the city is going to do something about this in the near, mid, and long range. The question is, who is going to do what and how much money is it going to cost? You know, Miami Beach was actually built out by the Army Corps of Engineers in the 70s and expanded. They dredged up a huge amount of sand, and potentially they can do that again. The question is who's going to pay for it and how prohibitive is that going to be for people to actually continue building? You know, if there are very, very high taxes, that's not really an incentive for people to continue to invest in the city.
Who's building? Because ostensibly you could say, well, the buyers don't know any better, or they need to put their money somewhere, or they don't care about 50 years' time. They're just worried about having a place on, you know, Miami Beach right now. But the builders presumably are looking longer term.
Well, actually, investment cycles are perhaps shorter than the long-term outlook that you might expect from these developers, because, you know, once they sell all of the units in their building, they're out. So I don't think it's quite as cynical as that. I do think that people have land and have these development opportunities and want to strike while the iron is hot or dry, at least. But also, I do think that there is this kind of widespread perception that someone's going to do something.
Yeah. I mean, are there any precedents? Has anyone, quote unquote, done anything anywhere else in the world?
Well, I mean, we're on shaky ground here. You know, climate change is obviously evolving, and the ways that people respond to climate change are evolving. What you're seeing in Miami Beach is this particularly profound moment where we can see the effects of climate change and rising sea levels, and we also see huge amounts of money pouring in regardless.
What about prices? Are they still going up in spite of all of this doom and gloom?
Yes, well, up until very recently they were. In the past few months, we've actually seen a plummet in sales in high-end development. So whether or not that's a kind of sign of, you know, kind of apocalyptic times, or whether or not that's a dip that we're seeing in the overall luxury kind of second, third home vacation investment is something that effectively remains to be seen.
And finally, James, are people at least moving in a little bit from the coastline?
Yes. In fact, a lot of buildings that are being built are not actually on Miami Beach now. They're actually in Miami proper, and some are even a few blocks inland. We'll see if people continue to recede away from the ocean.
Maybe we can look at it as a testament to human optimism. People are still building and buying in Miami. All right, James Tarmey, thank you. That's Bloomberg's James Tarmey. And for more, check out Pursuits, your destination for the finer things in life, including travel, watches, dining and property. Just head to NI Pursuits Go on the Bloomberg. Still ahead, an exclusive interview with IMF Managing Director Christine Lagarde. That's coming up. This is Bloomberg. It's 1 p.m. in New York, 6 p.m. in London, and 2 a.m. in Hong Kong. Good afternoon. I'm Bonnie Quinn. Welcome to Bloomberg Markets. Headquarters in New York. We're covering stories out of Mexico City, Toronto and Paris this hour. Here's what we're watching. A mixed picture for the U.S. jobs report. 178,000 added in November. So hiring picking up, but wages declining month over month. What does this mean for the Federal Reserve and for the markets? Fed Chair Janet Yellen's future has been in question since Donald Trump was elected president. But the two could become allies rather than enemies. Plus, an exclusive interview with IMF Managing Director Christine Lagarde. Bloomberg's editor-in-chief, John Micklethwaite, will ask her about everything from women's economic contributions to the world to US-China relations. We are halfway into the trading day, though, and Bloomberg's Abigail Doolittle is here with the latest. Abigail.
Not a lot of action for U.S. stocks, Bonnie. We see the three major averages are all trading about even. The Dow trying to flip into the green, followed the S&P 500 and the NASDAQ, which the gains for the S&P 500 and the NASDAQ have become a little bit bigger over the last couple of minutes of trading, but still really pretty small, telling us that investors are weighing in, saying that the non-farm payrolls report is pretty much a non-factor. As for where we're seeing some more trading action, we're looking at the commodity complex. Both oil and gold are trading higher. In fact, oil is higher today, but on the week, oil is up more than 11%, on pace for its best week since August of 2015. This, of course, on the OPEC supply cut deal, the first in 8 years. We have gold rebounding a little bit. Gold yesterday touched a 9-month low, but trading higher today, and it appears that both of these commodities could be trading higher on a little bit of dollar weakness. As for the currency markets, often a tell on, risk off. Today we're looking more just at a picture of stability. We have the British pound trading higher. In fact, the pound is on pace for its fourth higher week in out of the last 5. This as the Brexit process appears to be slowing. We have the Haven yen rallying just a little bit. The South African rand is rallying, which is not shown this way, but it is in rally mode after the S&P kept its rating above junk. And then finally, when we take a look at the Mexican peso, it is holding on within the post-election range, even despite the fact that the country's central bank chief has quit. So interesting picture here within the currencies, Bonnie.
Absolutely. There's always currency news in the works. Abigail Doolittle, thank you for that. Now let's check in on the Bloomberg First Word News this afternoon. Emma Chandra has more from our newsroom.
Thank you, Vonnie. House Speaker Paul Ryan tells CBS's 60 Minutes news programme he plans to propose policy that will focus on simplifying the tax code. He says the plan could, quote, fit on a postcard. He also says our thinking isn't how to redistribute income in America. We don't look at the economy as if it is some fixed pie, and we have to re-slice the pie. Michigan's Elections Board has deadlocked on President-elect Donald Trump's request to prevent a recount. That means unless the courts intervene, it will start next week. Meanwhile, the Michigan Attorney General is asking the state Supreme Court to intervene and stop the recount. That motion is pending. A Wisconsin recount is underway, though Trump supporters have filed a federal lawsuit trying to stop it. And in Pennsylvania, Trump is asking a court to dismiss Green Party candidate Jill Stein's recount request. Donald Trump has named Blackstone Group CEO Steve Schwarzman to chair his President's Strategic and Policy Forum. The forum will be made up of business leaders who will advise the White House on how government policy affects growth, job creation and productivity. Other CEOs who are members include Mary Barra of General Motors, Jamie Dimon of JP Morgan and Disney's Bob Iger. Voters in Italy may decide the fate of Prime Minister Matteo Renzi on Sunday. Renzi says he'll resign if a referendum on constitutional reform isn't approved. The proposal would reduce the size and powers of the Senate. Renzi and his supporters argue it will make it easier to pass legislation. Opponents say it could give the Prime Minister too much power. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg. Vonnie.
Emma, thanks. A little bit of a mixed picture on the jobs front, you could say today. The unemployment rate here in the U.S. has dropped to its lowest since 2008, now down to 4.6%. We also saw a decline in wages, month over month at least. Let's bring in Bloomberg's international economics and policy correspondent, Michael McKee, to help break down the numbers. He's with us from Washington. He was at the Labour Department this morning. Michael, this 4.6% unemployment rate is now below what the Federal Reserve has been considering full employment in the United States. Are we all clear?
Well, you're never all clear, Bonnie, but it is kind of a nice coda to where we have come from. Because in August of 2007, the last time we were at 4.6%, the financial crisis was just beginning. You remember we had a couple of hedge funds in France freeze up, and that was the tip-off to the financial crisis. 9 years later, we are finally at the point where we're back down to a 4.6% unemployment rate. So we have now passed through the crisis, and maybe we're starting a new economy, a new kind of move forward. We do have the concern, though, about whether race this low brings up inflation. That's something the Fed is going to have to watch.
All right. Well, Michael McKee, Bloomberg International Economics and Policy Correspondent, thanks for that. Now let's take a look at the broader global economic backdrop with one of the most important players on the world stage. Bloomberg Editor-in-Chief John Micklethwaite is speaking exclusively now with IMF Managing Director Christine Lagarde. It's part of Bloomberg's Enterprising Women series.
Angela Merkel or Hillary Clinton, almost. And the second is women in power all the way across the world. And you know the statistics better than I do. You have the McKinsey report saying that you could increase global GDP by 28 trillion, maybe by 12 trillion if you may alter a bit for regions. There's a huge gain to be had there. You've talked about it being the great economic no-brainer. So why hasn't it happened?
That's the trillion-dollar question, actually, because when we look at what is needed for everyone, we tend to say that we want more growth. We tend to say that we want more diversification of the economies so that they don't rely on one single source of resources. We tend to say that we want less inequality because we are now really demonstrating that excessive inequality are a source of instability and are not conducive to sustainability of growth. So if you park just those three buckets, more growth, less inequality, more diversification, including women in the economy addresses those three issues. It increases growth significantly, and you know the numbers, you have them as well, and many in the room have them. You can increase US GDP by 5%, but you can increase Indian GDP by 27%. If you look at diversification, we have now documented evidence of the fact that when women participate in the economy and in the labor market as much as men do, you have a more diversified economy. And by bringing women to the labor market, giving them access to finance, you reduce the inequality. And we've really now documented extensively at the IMF that you can actually reduce the Gini coefficient by 10 points if you have women participation in the labor market at the same level as men. So, and we can talk about the corporate world later on, but it's just completely obvious, which is why I've said that it's an economic no-brainer. Yet it is happening very, very gradually. And it's only happening a little bit faster when there are quotas, incentives, in order to push women into both the labor market, access to finance, circles of decision makers, parliaments. When you look at the number of women in parliaments around the world, it's about 20%. And it should happen. So we have to ask, why is it not happening as you just did? What is preventing women from achieving what they can achieve?
Do you think it's something to do with the leaders? I mean, just to give you an example, you've got President Abe, he's been in Japan, he's been trying to do stuff, not much has happened. Or even look at Barack Obama. Some people in this room might feel that he did do something by pushing money towards low-income workers and things like that, but in terms of diversity of his cabinet, in terms of doing things specifically to help women, it would be hard to claim he did a lot.
You know, I think that there is somehow, I'm a very optimistic person by nature, but I think that I see, and I hope this will last, some momentum in that field. When I was at the last UN General Assembly, a few blocks from here, the UN Secretary General said, "I am a feminist." Justin Trudeau said, "I am a feminist." The Prime Minister of Jamaica, who's heading that group, says, "I am a feminist." Great. Now, I think it is up to us, women and men who have vested joint interest in this, turning to them and saying, you are the leaders in your respective countries. You form the leadership of the world. Show us how you're going to be feminist and who you're going to hire, who you're going to promote, what policy measures you will have in place, whether your infrastructure programs are going to focus on what is actually helpful for women in order to limit and eradicate, hopefully, violence against women, how you're going to put in place inclusive finance so that women are not the victims of the middleman, the violence that is, eventually in developing countries gets into the way of them being economic actors. How are the 90% of the countries going to demonstrate that they eliminate the legal discriminations that are embedded in their constitution or in their legal system? That, it came to me as a huge surprise. 90%. Can you believe 90% of the countries of the world have in their legal system a provision or an article in the constitution that is actually a discrimination against women? So there's plenty to be done for those in leadership who can demonstrate that they are feminist. Okay, that's
I'm
great.
sure, just use Barack Obama as an example. I'm sure he would have also said he was a feminist. We've had 8 years of...
He actually did.
You had 8 years of him, and yes, you've had more pay for low-income workers, and you've had some degree of equality stuff in terms of pay within companies, but it would be hard to claim that he has pushed the cause of women forward, wouldn't it?
Maybe there are a few things that he would have liked to do and has not been able to do for some reason. But, you know, I wish, particularly in this country, there was a serious parental leave. You know, I mean, it's one of the few countries in the world where it doesn't exist, except in great companies like, I'm sure, Bloomberg.
We've done, yes. we can come back to the issue of Donald Trump and parental leave, because I think it's very interesting. But it strikes me at the moment there's two sort of arguments for how to change the role of women in the economy. One is that we need more diversity programs, those sort of things. But on the other hand, the main effect in terms of pushing women forward is just simply ennobling, enriching low-income workers, which include a disproportionate number of women. Do you think, in the end, the bigger gain is going to come from general economic policies, or for things particularly aimed at women?
Both, absolutely both. You know, minimum salaries, yes, absolutely. Earned income tax credit, yes, absolutely. But this is not going to be sufficiently focused on women. So I think that the combination of a serious and well-funded parental leave combined with, you know, money. At the end of the day, you need money. And you get your return on assets, or return on investment, rather. But if you have sufficient budget to cut childcare costs or childcare centres or whatever system people resort to, reduced by half, you automatically encourage women to join the job market. So I think it's a combination of measures intended for low-income earners, but it's also specific measures that, for cultural or historical reasons, are targeted for women.
Just focus on that parental leave question, which you raised. I think only 12% of women across America get it at the moment. If Donald Trump was to do that, and you have his daughter a particular supporter of that, you know, would that be a revolutionary step in terms of what involves?
I think many women would actually welcome a parental leave that would be financed properly and that would be legally prescribed. So that would certainly be a big plus.
Do you have any explanation why America is a long way behind Europe in that regard?
I think the whole... No, I mean, that's a really broad question. You know, if I look back at my own country, for instance, in France, a lot of those measures and policies and programs were put in place in 1936, at a time when you know, the socialists came into power, changed the course of things. If you look at American history, the major shift that occurred was FDR. And that was a bit later on, with no clear focus on welfare benefits and social security to the same extent that it had been in many European countries. But hopefully, you know, people will get there, and health and security in that domain can become part of people's entitlement and rights.
Can I ask you a bit about corporate boards and the question of quotas? Do you think that is the one area where quotas are justified?
Yes, I do think that quotas are justified in many, many areas, but I think on boards as much as elsewhere, quotas are needed and are helpful. It is, I mean, if you look at a country like Norway, for instance, there's been a jump in women's participation on boards as of the time when quotas were put in place. In Europe now, thanks to the European directive, it is also now getting close to, or sometimes above, the 20% threshold, and that threshold will go up to 30%. So there is clearly attention paid by existing board members and by shareholders to the fact that it is better, it is more, I mean, there is now plenty of documented evidence about the fact that there is a better return on assets in those companies that have one or more than one women on the board. And it's even more true in those companies that are based on knowledge. And I think it's really important when you see how the service industry is clearly expanding in the field of knowledge use. Women are clearly contributing even more so in those sectors than in these sort of standard manufacturing sectors.
But you also probably accept that quotas is one of those words which sort of terrify people to some extent. Is there a case at all for having quotas that last for a sort of limited amount of time?
Sure. Sure. I mean, once the quotas... Look, when I joined Baker McKenzie, I thought that because I was such a brilliant lawyer, I would make partnership and I didn't need anything. But then I looked around. Well, first of all, I realized that I was not just such a bright person. But I looked around and there were so few women that if you calculate, you know, over the course of time and based on historical data, it would have taken more than 120 years before there would have been even close to parity between male and female partners. So, yes, quotas are a needed step in order to reach an objective. Once the objective has been reached, then you need to reset the parameters of what you want to do, because then you want to keep people. Because any, you know, consulting firms, any particularly, I think the work has been particularly done in professional firms. You lose talented women at a particular point in time in their life because their career development and their biological cycle coincides at pretty much the time when you need to be super performing and when you're going to be super creative.
And I remember reading one. I hope so. I remember reading something about your very first job interview, where I think you were told that you would get paid less because you were a woman, or something along those lines.
No, it was worse than that, because you know you paid less. Okay, maybe you don't have as many diplomas. Maybe you're not as. But it was worse than that, because what I was told was, you know, please join. You have all the credentials, all the good background, everything works fine, and we'll give you some interesting work, but don't ever expect to make partnership. And when I said, why is that? They said, because you're a woman.
But
now, maybe things have improved a bit.
But over that time, exactly. No, but what do you think has been the big gain that has happened since then, and what do you think has been the big thing that you expected to happen that hasn't?
First of all, particularly in my position as head of the International Monetary Fund, I'm always a bit cautious about passing general judgments about women and what is needed, what would help, what has failed, because it is so different whether you look at Peru or you look at Namibia or you look at the United States or you look at Sweden.
We'll just look at the West, maybe, because that would be the...
So advanced economies. I think in most of these advanced economies, including Japan, and we can come back to Japan if you want, there is a clear general consensus that certain things have to be done, certain things have to not be done, certain things have to be said, certain things have not to be said. And I hope that stays that way. So there is a momentum, and you know, there's a political force about women sharing that objective, sharing those views, and being prepared to close ranks and claim their place in the economy, their place in finance, their place in the world. So that's the positive. I think enough sort of self-awareness and probably a bit more solidarity amongst women, which was not a given in the mid-late 70s. What has not improved is very often the perception of others, and that goes to the cultural elements. You talked about Japan. In Japan, I think many women have, including his wife actually, have convinced Prime Minister Abe that it was critically important to improve the position of Japanese women, to welcome them to the workforce, to make it equal for them, to facilitate the custody, not custody, but the guardianship or the caring of their children while they were at work. Yet it is not changing massively yet. So the perception, the cultural environment, the misrepresentation, the apprehension, which is often the result of how other people perceive women, not so much how women perceive themselves, that has not changed. But speaking of how women perceive themselves, there's a lovely book by Kathy Kay and her friend about the confidence factor. which I think is still true today. And that's, you know, I wondered why I came into this room with my notes. It's a factor of my insecurity and my lack of confidence.
I have notes too.
But then I saw that John had his.
On that subject, you talk about women closing ranks. I mean, at the moment in America, there is a very obvious counterexample. You had a woman running for president who was extremely well qualified. You had a man running against her who had, let's put it this way, less qualifications on the face of it. And on top of it,
he wasn't a woman, that's for
exactly. But on top of that, he'd also been caught, I think, saying things which most people would interpret as misogynist. And yet, most white women voted for Donald Trump. What does that tell you about that sort of idea of women in power?
Well, I would hope that, irrespective of what happened in the past, that respect, dignity, elegance in dealing with people, not in the way people are wearing clothes, would prevail over low instinct and disparaging comments.
But all the same, it does seem to put it this way, maybe misogyny doesn't matter as much as some people say.
I hope not.
Maybe but on Donald Trump to revitalise the reputation.
And I hope not, and I think that it is each and every one of us responsibility to make sure that it is not.
But
and it's more of a human dignity issue than a female issue.
What about the issue, just on staying on Donald Trump for just a second, you know, we've said these bad things about him.
My comments were not addressed to him. My comments are general, because there are many corners of the world where women are suffering an attitude which puts them in a lower position or in a subordinated situation or in a state of dependency and humiliation which is unacceptable.
Yes. On the issue of Trump again, we talked a bit about parental leave and what he could do there.
Yeah.
Are there other things where, despite some things he said in the past, where he could sort of, I suppose, reverse that reputation?
Well, you know, when I hear the words inclusive, I listen very carefully, because inclusive means inclusive growth, means inclusive finance, means opening up to all, making sure that there are opportunities for all. And if that is the intention, then I think that is important for women and for those who are and have been excluded. So that is, you know, parental leave is one. As I said, the earned income tax credit at the lower end of the income range. I think inclusive finance is a critically important thing. There are 60 million American people today who are either underbanked or not banked at all because they have no access to finance. So those are really good propositions. If they can be delivered upon, that certainly would make a difference, including for women.
I'll just stretch the thing slightly broader on the issue of the economy.
But your parental leave ideas is a very
that
important...
would be a big one. Would that conceivably make Trump a better president for women than Obama was?
Oh, come on. We're not in that sort of...
It's always worth trying. There's only a small group of people here. Stretch it more broadly on Trump and the economy. Many of us have sat there saying, look, the world has got to change from relying on central banks. Governments have got to start doing things. Look at what Donald Trump is talking about. He's talking about spending money on infrastructure. He's talking about pumping money into the economy. Is it possible that that's another area where he could surprise on the upside? Are you optimistic about what you see he's doing so far?
Well, I would preface any comment with, you know, we're a bit lost in conjecture for the moment, because there are certain things that are coming back, whether it's the spending on infrastructure, whether it's the tax reform. There are things that we hear that are hinted more than affirmed, such as the trade policies. So it's very premature to sort of draw conclusions at the moment. But we have consistently said that the tax system in this country needs to be reformed, needs to be simplified, that corporate tax needs to be lowered and tax loopholes eliminated. That the, you know, if that at the lower end of the income range, less taxation would be extremely beneficial for growth. So on the tax front, if what we hear is heading in that direction, this is beneficial on two fronts. One, on growth, because it would certainly boost growth, and it's also beneficial on the risk of a very divided society with the elite of the haves and the elites and the others, the have-not. But it's a question of how that tax reform is designed, okay, and how many jobs are created as a result. Second area where, you know, is the beginning of proposals are also welcome is in the area of infrastructure. Infrastructure is badly needed in this country. Whether it's, you know, port, roads, railroads, airports, there has been reduced public spending on even the maintenance of what exists. So this is needed. How it will be financed, whether it will be public funding, whether it will be incentives to the private sector, is also going to matter in terms of output. So in the short term, if you only take those two blocks of proposals, it's rather positive for the United States. But it needs to be factored into a longer-term proposition. And clearly with entitlements kicking in 2021 or so, with baby boomers retiring, with interest rates likely to rise, and certainly interest repayment rising at around the same time, the decisions that are made today, to the extent that they possibly increase inflation, that they make financing more expensive, that they strengthen the dollar, all of that is going to also have an effect.
Do you see a stronger dollar as just? Do you see a stronger dollar as just a given over the next few years?
It's very likely. If those policies are implemented, it's very likely, and it will have both good. Well, it will have, you know, downside and upside consequences.
What about the obvious? If that is the obvious good thing about Trump, from your perspective, presumably the worry is trade. And especially the idea of maybe a trade war with China or any of those particular. Recently, there have been somewhat more clement noises about that. Do you think that's a fair reading?
Well, the more moderate approach to trade is probably predicated on the fact that trade has been beneficial, and has been beneficial not just for the 100 millions of people who have been taken out of poverty around the world, particularly in Asia, but around the world, but has also been beneficial in terms of improved competition, better allocation of the factors of production, including capital, certainly lower prices for consumers in the advanced economies, which have generally benefited, in particular, people at the low income level.
What about the issue?
When you realize all that, you sort of consider whether trade is not actually a reasonably good thing, but, and that's where I would be very interested also to hear what will be, it needs to be associated with clear measures that will benefit people who have been left out. So, because if you combine international trade and the massive increase that we've had in the last 30 years, the technology improvements, and it's very difficult to dissociate the effects of one versus the others, but they are combined, and they've created pockets of unemployment, people completely left out of their jobs, factories that have closed, and regions that have been devastated. That needs to be addressed. It cannot just be about trade is great, cheaper products, more consumption, better allocation of the factors of production. It needs to be trade that benefits all. And for the moment, that second part, which is addressing the issues of dislocation of supply chains, people displaced, people out of their jobs and out of any training,
surely the problem there is that trade doesn't benefit all. It benefits different people in different ways. It benefits, as you pointed out, lots of poor consumers in America, but there will also be people who are obviously hit by it and are frightened about it, and they are the people who voted for Donald Trump and for Brexit.
And there are generally those people who have either lost their job, or whose job is not paying them so much anymore, or whose children are not going to get a job in the same vicinity as where their parents have been because of change in the supply, in the manufacturing supply chain, because of the fact that it's a lot cheaper to produce elsewhere than in such or such state in the United States. And that's where a particular effort needs to be put in place. By way of social safety net, by way of minimum salary, by way of, as I said, earned income tax credit, and a focus on, okay, you've lost your job, but there are other jobs that are coming up. The US economy is constantly creating lots of jobs. Question is, how can they be helped towards these jobs in a more efficient way than has been tried so far?
The particular thing with China is always this issue about whether the yuan is being, whether the renminbi has been held down. And I think the IMF generally has tended to say that China is not a currency manipulator. Are you still in that position?
You know, we evaluate the status of a currency relative to its economy on an annual basis, every year. With most economies of the world, we determine whether it is underappreciated, overappreciated, or generally, or we say broadly, in line with the fundamentals. On China, the latest was in Article 4 back in June or July, and at that time, the renminbi was broadly in line with fundamentals. After having been probably held up for a period of time, more than was required by the economy. Now, clearly, in the last few weeks, the renminbi has depreciated because the Chinese authorities and the banking authorities in particular are now aligning the determination of their currency relative to a basket of currencies. And when the dollar appreciates, which is one of the components in the basket, clearly other currencies around the world, including the renminbi, are declining because it's a zero-sum game. When one goes up, others go down.
Shall we return to the continent from which we both came? The joys of the Italian referendum. How frightened are you by that? Is that you have lived through several versions of the euro crisis. If Renzi were to lose, particularly lose badly, would that spark off another round of it?
You know, we tend to look at the Italian economy irrespective of what the outcome of the referendum is. I mean, so far we've really experienced polls, forecast, absolutely determined view as to what the outcome will be, and we've seen how wrong we were. So we look at the Italian economy independently and irrespective of the outcome of the referendum and Matteo Renzi's decision to stay as president of the council or not. And a lot needs to be done on the Italian economy, irrespective of the referendum. Even if there is a yes vote and the Italian Senate is sort of power reduced, a lot needs to be done on the banking sector, as we know. Recapitalization is needed, strengthening of the books by elimination and dealing with the non-performing loans that are stuck in some of these banks. A lot needs to be done on the productivity front, which has not improved by far. So the Italian economy needs a lot of reforms, and
there's another large country just above Italy where you might say that has needed a lot of reforms. You've now had the removal of Sarkozy, of Juppé, of Hollande has now gone. This new generation of people coming in. Do you think that France is more likely to be reformed now? You famously worked with François Fillon.
Well, we at the IMF...
Even the French people.
We certainly view France as a country that needs to continue seriously in-depth reforms of its economy. And whoever is elected comes next May will have to tackle head-on the need for structural reforms. The labour market has begun a reform, but it needs to be faster and deeper. Product markets have begun to reform a little bit, you know, in the bus sector. Okay, great, but you know, we need a bit more than that. That economy needs more than that. And it has the benefit of this accommodating monetary policy by the ECB, which presumably is going to continue for a while. The price of oil is still low, even at around 50, which is maybe where it will hang for the next few months. The euro is, you know, 105, 106 to the dollar. It's not bad when, you know, when you're an exporting country. and you buy oil at a reasonably low price per barrel. So the whole scenery, the whole landscape should be really favorable to those structural reforms and a limited use of fiscal space, because fiscal space can only be used appropriately to support the structural reforms. It cannot be an invitation to just increase public spending. There's plenty of public spending in France at the moment, so it needs to be rejigged, reorganized and reshaped, which is being talked about.
I saw a cover of Libération the other day which showed François Fillon
with a wig,
converted into Margaret Thatcher.
Yeah.
Is he a big enough personality, in your view, to be the Margaret Thatcher of France?
What I know of him is that he's certainly a determined reformist. He's also fiscally prudent, but I think I've seen him I've worked with him for 4 years, and he's certainly very lucid in terms of the diagnosis about the French economy. He's the one who, 3 months in the job as Prime Minister, said, I'm the Prime Minister of a bankrupt country, which didn't please very much the President then.
He's now running against a man who described France as Cuba without the sunshine.
That's right, that's right. Well, they will have to compare holiday destinations together.
We've probably done enough bashing of France. There's another country even further to the north of that, which is trying to leave.
Hang on, I'm not bashing my country. No.
But you have often said before that reform there is far too slow, and you're now saying that there is a chance of it changing.
Yes, I should think so. And when I joined the government as finance minister with Prime Minister. With François Fillon as Prime Minister, our goal, our determination was to reform. And unfortunately, the financial crisis just came to hit us 6 months in the job. And we had to, back up and go about rescuing the financial sector and trying to calm depositors and make sure that the economy would not contract too much as opposed to what we were preparing to do.
I mean, in the name of fairness, I was going to get up to Britain. You have this continual...
No, that's your country.
Exactly. No. Here's your chance to bash Britain. That you look at Britain, is that now, in your mind, is it moving a little bit away from hard Brexit to soft Brexit? They're suddenly making more conciliatory noises, or is it still going to be a very short negotiation where the British walk in and say they want access to the single market and the ability to control their immigration, and the Europeans say that's an either-or, you have to make a choice?
All the noises, all the comments, all the little posturing here and there seem to indicate that we are still looking at a hard Brexit. And it's, our hope at the IMF is that the uncertainty is cleared, because that's the first factor that is really, for the moment, questioning investment decisions. I know that there are numbers that seem to indicate that there is still investment, there is still movement, but when you talk to people, they are really concerned about what the outcome will be. I think in the financial sector, a lot of clarity would help, because the financial passports that banks located on the British territory, and I should say the English, should I say British or English? I never know.
British, it's
British. That exclude Ireland as part of the EU, which it is as an independent country. But those banks on British territory will want to know, and their shareholders will want to know, whether or not there is a passport to continue to act in the rest of Europe.
Do you think the kind of two-year deadline, Mrs May goes and invokes Article 50, and then it takes 2 years, that's really becoming... It's going to take longer than 2 years. We had Enda Kenny, the Irish Prime Minister, this morning, he was saying that.
Yeah, most people who are close to the preparation, and on both sides they are preparing and they are trying to move along the curve, they're all saying that it's going to take longer than 2 years. I mean, when you look, it's going to be something like 60 different bilateral trade treaties that will have to be negotiated, if only that to begin with. And then you have to disentangle the system. And I hear what is being said, which will be, okay, well, let's keep it as it is, and we will gradually remove what we don't like. I don't think it's going to be,
You can't, so the British can't cherry pick what they would like from Europe.
But it's a negotiation. You have two parties. And I don't want to opine as to who is in the strongest position, but I'm not sure.
Can I ask one last question? I think I get the message. There's one last question to do with globalization. If you think of all the things we've spoken about today, we talked about trade with China and America, we talked about Europe. At one time, the whole future of trade, very much tied up with the IMF, or very much tied up with what you think about, was towards these big global trade deals. Now you see Trump trying to do things on a bilateral basis. You've talked about Britain having to do bilateral deals. Is there an element of deglobalization beginning to happen, or do you think there's a way through with all these little deals?
I certainly hope that there is not a move towards deglobalization. I equally think that we have to move towards globalization that has a different face, and which is not excluding people along the way as it proceeds towards increasing or improving the development of those developing countries of, say, Africa and some of the Asian world, and moving up for the emerging market economies. So I hope it's not deglobalization. I hope it's a different globalization. From a purely institutional point of view, I would hope that the WTO continues to do the hard work that is required to have a framework within which other arrangements can be had, but it's clearly taking a different form, and the Bali Agreement has not yet been ratified. The Doha Agreement is a bit of the story of the past now. So a new framework has to be invented, and I hope that it can be proposed in sufficiently attractive way that are compatible with regional or bilateral agreements as well, which is clearly the road that it's taking. My IMF colleague are probably terribly upset with me because I'm supposed to say that a global deal is better than a lot of bilateral deals, and the spaghetti ball is not desirable. But I think that's.
You just want one flat pizza instead.
No, I think a bit like in Europe, you have the subsidiarity principle, and I'm not suggesting that the global trade should be operated a la Brussels. But I think that having a general framework, which does not necessarily goes into the details, but is compatible with bilateral arrangements that can be negotiated, or regional arrangements that can be negotiated, might be a way for the future.
Well, that's something to hope for. Christine Lagarde, thank you for talking to Bloomberg Television.
Thank you.
Thank you.
That was John Nicholson. Bloomberg's editor-in-chief with Christine Lagarde, managing director of the IMF at Bloomberg World Headquarters in New York. Now, the event was Enterprising Women and a discussion of women's issues here in the US and around the world. And Lagarde says it does make sense to have quotas on boards to encourage women to move up the workplace and to encourage equality in the workforce. On the broader economy, she said things like the stronger dollar would be likely if proposed policies from the president-elect, that's Donald Trump, go ahead. She also spoke about Europe and talked about the Italian economy, saying it needs a lot of reform, including within the banking sector. She mentioned France as well, and the new French president needing to tackle structural reforms when that actually happens, that election, and the French labour market making it a faster, deeper labour market. So let's have a look now at what the markets are doing on this Friday as we head towards the middle of the afternoon session. You can see that the Dow Jones Industrial Average is down about 0.2%, so giving up its gains on the week, really. It's only about 32 points lower, and it has made 9 record highs since the election, but 19,159 is the absolute level now. The S&P 500 at 2190 is unchanged, and the Nasdaq Composite Index is just holding on to a 3-point gain. The VIX has been moving around. It's currently above 14, just a little higher. The dollar index, though, and this was again discussed by John Micklethwait and Christine Lagarde, it is below 101 again. A little weakness, or you could say consolidation this week. Cable at 126.94. That's stronger British pound today. Again, that's off the back of dollar weakness. And it's worth mentioning the South African rand as well, because we did finally get that decision from S&P holding the negative outlook, but not dipping South Africa any further into junk. The rand then trading stronger by 2.2% on the day. It's trading at 13.80. Crude, I'm looking at Brent because that's trading at 54.26 a barrel. WTI here in New York about 51 change. And the 30-year is off its highs. The yield at 3.04%. I did stick in the Italian 10-year yield there as well. That traded as high as 2.04. It's now back down to 1.9. You're watching Bloomberg Markets. From Bloomberg World Headquarters in New York, I'm Bonnie Quinn, and this is Bloomberg Markets. Mexico Central Bank Governor Agustin Carstens announced this week he's resigning his post next year to run the Bank for International Settlements. Now, Carstens leaves Mexico without its best-known policymaker amid new economic challenges from the Trump administration. In an exclusive interview at the bank's headquarters in Mexico City with Bloomberg's Eric Schatzker, Carstens tried to ease any concerns surrounding his departure.
I'm the visual face of the bank. That gives me, I would say, certainly more presence. But when it's time to vote, my vote counts the same as the others. All our communications are established by consensus. And I mean, obviously, that gives me tranquility that the bank will be in good hands when I leave.
You can watch more of this exclusive interview with the outgoing Bank of Mexico Governor Agustin Carstens at the top of the next hour. Now we want to get to some news that just broke in the last hour. Saudi central bank computers are said to have been damaged by Iranian malware. Joining us from our Washington, D.C. bureau with the latest is Bloomberg News cybersecurity reporter Michael Riley. Michael, how extensive is the damage?
So this attack started on November 17th, and it looks like it's hit multiple agencies, government ministries in Saudi Arabia. This is a very destructive type of malware which essentially destroys computers, makes them inoperable, and erases all the data on them. There are at least 6 targets. We know that the aviation ministry has been hit and the transportation ministry is hit. We don't really know that much about how extensive the data is inside the central bank, but you can imagine the central bank plays a key role in the economy of Saudi Arabia. So any kind of damage in a network like that is going to be significant.
Yeah, and we also know that Saudi Arabia has been making huge efforts to sort of shift its economy in a different direction. So how much information would the Iranians have got from this hack, if indeed it does turn out to have been the Iranians? And what good would it be to them?
So this is a kind of an unusual hack. This sort of counts under the category of cyber war rather than espionage. So the hackers didn't go in and take information. And in fact, investigators have been trying to track whether information was taken before these digital bombs were released. And they haven't found any traces of that. What they were actually trying to do is just some level of significant destruction of the networks themselves. So this is more like throwing a grenade into a network rather than a spy sneaking into a network and stealing information.
Will the Saudis have to rebuild from scratch? Do they have the firepower, the manpower, and the intelligence power?
So that's the question in terms of the only way to recover, since this malware basically destroys the computer and the computers and the data that's on it, basically it really depends on whether or not that data was backed up and saved someplace else. I think there are initial indications that the Saudis, at least in some of these ministries, did have backups of this data, which will make sort of recovery of the network a little bit smoother. But effectively, you have to rebuild it. You have to replace all of these machines. And if that data wasn't backed up, then it's lost forever.
Michael, will there be retaliation?
So that's obviously the question. The Middle East has been sort of a tit-for-tat cyber war over the last several years. The Iranians have been hit by attacks on their nuclear facilities. They've been hit by attacks on their natural gas facilities. The Saudi Arabia has been hit by attacks on its oil facilities, and now a widespread attack on its government ministries. You can almost bet it's not going to stop here. So the question is, what's the next level of escalation?
Michael, why do this? I mean, is this just mischief on the part of Iran, if indeed it turns out to have been Iran? Or could it be just some kid somewhere discovered a way in here?
So the malware that was used is associated with Iranian state-sponsored hackers. It's exactly the same malware that was used to destroy 35,000 computers in Aramco. Now, in the weird world of cyber, another nation state could try and be making itself look like Iran. There are lots of motives you might do that. This could affect the nuclear cord, for example. But all fingers at this point, at least the evidence at this point, points back to Iran. So if it turns out to be Iran, the question is why? And that's the real issue. Is it related to the election and Donald Trump? Is it related to OPEC?
Yes.
We don't know at this point.
Michael Riley, you're on the case for us, and thank you for that update. Appreciate it. This is Bloomberg. now for the latest Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. Deutsche Bank is reducing some coverage for about 3,400 actively trading clients in global markets. That's according to the Wall Street Journal, citing a bank memo that says the move is, quote, with immediate effect. The memo also says the action is aimed at balancing risk, revenue and profitability. Deutsche Bank has confirmed the memo's contents. US and Brazilian regulators will hit Odebrecht, Latin America's biggest construction company, and an affiliate as well, with a $2.5 billion fine. That's a global record. People familiar with the discussions tell Bloomberg all of this. Now, prosecutors say they paid to win contracts from state-run oil producer Petrobras. Odebrecht has admitted it participated in what it's calling inappropriate practices. This after Bloomberg reported 60 executives were signing plea deals. And that is your Bloomberg Business Flash update. Coming up on Bloomberg Markets, an exclusive interview with outgoing Banco de Mexico, Banxico, Governor Agustin Carstens. This is Bloomberg.
It is 2 p.m. in New York, 11 a.m. in San Francisco, and 7 p.m. in London. I'm Oliver Rennick.
And I'm Scarlett Fu. Welcome to Bloomberg Markets. We're live in Bloomberg World Headquarters. headquarters in New York over the next hour, plus we're covering stories out of Mexico City, Vienna, and Rome. Here's what we're watching. Bank of Mexico Governor Agustin Carstens joins us in an exclusive interview. He tells us why he's leaving the central bank to take a new position at the Bank for International Settlements, and he tells us how his departure will impact Mexico's economy. OPEC delivered an early Christmas present for oil executives and shale producers. We'll look at whether oil can build on its huge rally this week. And President-elect Donald Trump has named Blackstone's Steve Schwarzman as chairman of his advisory panel on jobs, joining names like Jamie Dimon and Bob Iger. How will these business titans influence Trump's policy? U.S. markets close in 2 hours' time. Let's get a check on where equities are trading with Abigail Doolittle. And I was surprised when I realized that the S&P is now holding at, what, a 2-week low?
You know, Scarlett, I actually don't know that, but the S&P 500 is on pace for a weekly decline, the first in 5, so that would probably make sense. As for the markets today, not a lot of action, really flipping between small gains and losses. The Dow down the most, and in fact, on the week, the Dow had been earlier higher on the week, right now right around even on the week, whereas the S&P 500, as I had just mentioned, is down on the week, as is the tech-heavy NASDAQ. Technology really weighing on the S&P 500 and the NASDAQ this week. As for what's moving today beneath this relatively calm surface, we do have a few big movers here, including Pandora and Sirius. Pandora is on pace for its best day since February. Sirius on pace for its worst day since February. CNBC did earlier report that Pandora is in talks with Sirius to sell itself, and Reuters also said that Pandora is looking to sell itself. eBay also nicely higher, as M Science's CEO Michael Mulare said that the company's core marketplace looks stronger than expected, so investors are clearly liking this, bidding up the shares of eBay. As for one market really on the move in a noticeable way today, we are looking at the 10-year Treasury yield having its worst decline since September 6th, and we see that in green. That, of course, because price does trade inverse to yield. So this tells us that the big bond sell-off in November is on a bit of pause here. This makes sense when you see such a massive spike higher in yield. The 10-year yield did spike higher by about 70 basis points, trough to peak between the November low and the high. Typically, you're going to see some consolidation of that. Plus, bonds are a safe haven asset. We do have the Italian referendum coming up this weekend, the FOMC in 2 weeks. So investors are taking a little bit of a restocking here and supporting the idea that we may continue to see the rally in rates maybe taper down a little bit is the Bloomberg Dollar Index. When we go into the Bloomberg and we take a look at #BTV 5161, this is a chart of the Bloomberg Dollar Index, and we see that into the first Federal Reserve raising rates last December for the first time since 2006, a nice rally. So investors really traded right up into that. A little bit of waffling now into the next time that investors are expecting the Federal Reserve to potentially raise rates, but supporting the idea that the dollar index is about to fall. The RSI, the relative strength index, hitting that overbought level, Oliver, of 70, coming back down, perhaps suggesting, as you know, rates typically, rising rates support a rising dollar. If the dollar index is going to fall down, it may suggest that we will see the rally in rates peter out too, Oliver.
Very interesting, Abigail. Great stuff. Now let's check out on Bloomberg First Word News this afternoon. Emma Chandra has more from our newsroom. Emma?
Thank you, Oliver. Michigan's elections board has deadlocked on President-elect Donald Trump's request to prevent a recount. That means unless the courts intervene, it will start next week. Meanwhile, Michigan's Attorney General is asking the state Supreme Court to intervene and stop the recount. That motion is pending. A Wisconsin recount is underway, although Trump supporters have filed a federal lawsuit to try and stop it. And in Pennsylvania, Trump is asking a court to dismiss Green Party candidate Jill Stein's recount request. Ireland's Prime Minister says the UK's decision to leave the European Union stands in stark contrast to its history as a forward-looking player on the international stage. Enda Kenny sat down today with Bloomberg editor-in-chief John Micklethwaite and recalled his reaction to the Brexit news.
Britain was always a really important member of the European Union and was a voice for change and was a voice for a vision for the future. Obviously, the decision then in Brexit came as a shock. It's something I didn't want to see, something that I didn't want, but I have to respect because it's a democratic decision, so we get on with it.
Kenny also said the UK won't be allowed to pick and choose which aspects of the EU it wants to keep as it prepares to leave the world's biggest trading bloc. A New Jersey judge has denied a request for a special prosecutor in a criminal misconduct complaint against Governor Chris Christie in the George Washington Bridge Lane closing trial. The judge dismissed the motion by a former firefighter who brought the complaint in October. It alleges Christie failed to order subordinates to reopen bridge access lanes in September 2013. The state-sponsored hackers who unleashed a digital bomb against key parts of Saudi Arabia's government over the last 2 weeks have damaged computer systems at the Saudi Central Bank. That's according to people briefed on the strike. The attack targeted at least 6 government entities with a computer-killing malware known as Shamoon. It appeared to come from Iran, but the investigation is still in its early stages, and so that determination could change. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg. Oliver.
I'll take it from here, Emma. Thank you so much. Coming up, an exclusive interview with Mexico's central bank governor, Agustin Carstens. He is leaving the bank in July for a new job. We're going to hear from him next. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu.
And I'm Oliver Rennick. Now let's put the spotlight on Mexico. Yesterday, Mexico's central bank announced that Governor Agustin Carstens will leave his post next year to run the Bank for International Settlements. The news was another blow to the peso, which is now down nearly 20% this year, making it the world's worst performing major currency. Moments ago, Bloomberg's Eric Schatzker sat down with Carstens in Mexico City for an exclusive interview. Eric asked him how he could leave the central bank just as a potentially destabilizing Trump era in the United States is about to begin.
I would say two things. First of all, Banco de Mexico is a very strong institution. It has very strong human capital. We work in an environment of a board of governors. My vote counts the same as the one of my other 4 colleagues. I'm the visible face of the bank. That gives me, I would say, certainly more presence. But when it's time to vote, my vote counts the same as the others. All our communications are established by consensus. And I mean, obviously, that gives me tranquility that the bank will be in good hands when I leave.
But leadership counts for something, and it might count for a lot more than something.
Yeah, but I'm sure that there is a good sample of people, a good group of people in Mexico that can step in. I'm also going to leave the bank until in 7 months. That will provide good time to organize a smooth transition.
If it were up to you, who would your successor be?
Well, that's not for me to pitch in.
Well, I know it's not your decision.
No,
I'm wondering.
But I don't think it's fair for anybody for me to say anything. I mean, I don't want to leave anybody behind without naming them, and so that they might feel themselves discriminated. I will not get into that. That's not my job.
Without naming names, at least one of the potential candidates to succeed you as governor doesn't meet the legal criteria. We both know who this individual is. Is it appropriate for the Bank of Mexico to impose these age restrictions and birth restrictions on the people who could most capably serve this country?
Well, I mean, for me, the most important restrictions are the ones of technical and political and organizational capacity.
Right, but what if the person who had those technical and organizational capacities weren't born here, but was the best person for the job?
Well, you know, that's not for me to decide. That's not for me to decide.
Would you want to see those restrictions changed?
I think that the law of Banco de Mexico is fine the way it is, without meaning anything with that.
Whomever takes that position is going to have a lot of work to do. The future isn't just uncertain. The future, as of today, might be described as grim. Economists in your own Bank of Mexico survey just reduced their GDP growth forecast right, by a half percentage point to 1.72% in 2017.
Yes. Well, I mean, what we have said, and I said we because here I mean also the Ministry of Finance, just after we found out the result of the U.S. election, we gave a press conference, and what we said there is still valid. And that is that Mexico has the commitment to adjust its policies to the environment that we will face. Now, the big thing is that we still have to know exactly what is the environment we will face as we move forward. Banco de Mexico has already acted. I mean, just 2 weeks ago, we increased our interest rates because we have seen some reactions already in the market, and that called for our monetary policy adjustment. But I can say that if other type of policy adjustments are needed, I'm sure that we will respond.
What kinds of policy adjustments are you talking about? What kind of contingency plan do you have in place should there be more turmoil in financial markets?
Well, first of all, we have cushions. We have very large international reserves. We have a flexible credit line with the IMF. The Ministry of Finance has this very responsible policy of hedging their exposures in the oil markets. They have a stabilization fund that is sizable. So first of all, we have elements to respond in the short term. Now, what policies can be adjusted in given time? Well, certainly monetary is one. That's the board commitment, and the fiscal policy, and well, obviously trade policy will also have to be reviewed once the full information is on the table.
Let's go back to rates for just a moment. You have a mandate, that's what you referenced, but how can the Bank of Mexico keep raising rates in its attempt to stave off, let's say, a weakening of the peso, for example, while the economy is weakening. It seems as though you're in a very, very difficult position with the threat of Trump, if you will, on the one hand, the economy weakening already, and inflation expectations running above 4%, again, in the same survey published today.
Well, Mexico has a big advantage, I would say, to many other countries, and that is that we have done structural reforms. And structural reforms still have a lot of potential, and that's a way to increase growth with time, with stronger implementation, and that in a way can allow us to concentrate on stabilization efforts, which, by the way, is a necessary condition for further growth, to have stability. And on the other hand, we are tackling the issue of growth on the most fundamental level. So I mean, obviously we cannot smooth every single movement in the business cycle, but I would say that the expectations towards a medium and long-term growth in Mexico are very good.
Is the bank prepared to raise rates further should inflation expectations continue to run well above your 3% target?
Absolutely.
Because that's the mandate.
Yes, and also because we have the conviction that the best way Banco de Mexico can contribute to growth is by keeping financial stability and inflation expectations in line.
You've been prepared to raise rates, obviously. Most other central banks in the world have not. Once you take this new position at the BIS, what will your position toward the low rate environment be? Your posture?
Well, you know, I don't have a dogmatic view. Of course, what you have to be aware when you're in a multinational environment is that each country faces its own problems. There is no one-size-fits-all. Business cycles are different, objectives are different. What I would say the BIS can do, and I think has done a very good job, is to provide a good fora for discussion, to try to get coordination and cooperation, and also to provide, I would say, a view for other central bankers, for central bankers to take the best decision possible, looking at the whole picture of the global economy.
Let me ask it of you this way. Should central banks and central bankers, because we're talking about people, begin to normalize policy in the absence of structural reform or fiscal stimulus? In other words, you know, is perpetuating this low rate environment, perhaps with a little extra added juice of quantitative easing, just creating too many economic risks?
Well, I would say that all my colleagues know the trade-offs of different policies. Obviously, there is this aspect that a very low rate environment can affect financial stability. But also as a community, international community, we have acted in that regard. We have the FSB, different regulatory and supervisory actions have been taken, and I can assure you that each one of my colleagues have been looking into this aspect very, very carefully.
We have a situation, though, among developed economies where employment levels are at close to, or unemployment levels, right, or close to what people normally associate with, quote-unquote, full employment. And yet, even with some pickup in the United States, wage levels are still comparatively and relatively speaking subdued. What's it going to take to break out of this pattern?
Well, here, I would say from where you started is where the answer is, and that is to coordinate and make consistent policy packages. A monetary policy has done and it's doing its job. But certainly, whenever there is space, fiscal policy would be important. And also, I have to say, many other countries haven't made the progress that we would like to see in the terms of structural reforms.
There's a role for banks to play as well, not just central banks. you've seen, as I've seen, global banks pull back from many of the markets in which they've been active. Is that a hindrance to the global economy? Is that making it harder to break out of this low growth pattern?
Well, you know, I mean, at the end of the day, we're coming from a global financial crisis, from a situation, from a crisis that, you know, we still haven't really gotten out of it. We are still in this environment. Obviously, it has been improving through time, you know, but I think it's undeniable that some excesses took place. And if at the end that means that banks and different financial institutions should have a narrower scope but a safer attitude, I think that that probably would be a good combination.
Well, there's been unanimity among regulators on that point for the past several years, maybe not for much longer. What do you think about the prospects for a significant rollback of post-crisis regulation in the United States under the Trump administration?
Well, you know, again, the devil is in the details. From what I have heard, from what I heard from the Secretary of Treasury elect, if you allow me that expression, one of the things, exactly, what he mentioned, he stressed a lot. I have been watching many of his interviews. He has been stressing a lot, but a lot, on the complexity on regulation, on the fact that, you know, he has said many institutions don't even understand the Volcker rule. No, I am also pro simplicity. You know, there is a certain amount. I mean, you have to make sure that the prudential levels that you want are there in the regulation. But given that, if we can simplify the regulation and in that way enhance compliance, I'm all for it.
So we don't necessarily need to be, call it, afraid of changes to Dodd-Frank.
Again, we have to see what the fine print is in what Mr. Mnuchin wants to do. But I'm completely supportive of his attitude towards making regulation more understandable, less expensive from the point of view of its administrative costs, but obviously keeping an adequate safety level.
That was Agustin Carstens, outgoing governor of the Banco de Mexico, speaking exclusively with Bloomberg's Eric Schatzker in Mexico City.
Still ahead, what will the final month of the year bring for global markets? We explore that next with our charts. This is Bloomberg.
This is Bloomberg Markets. I'm Oliver Rennick.
And I'm Scarlett Fu. Well, now that November is in the rearview mirror, let's move ahead and chart what lies ahead for global markets. Oliver, you've got a couple of charts you're focused on.
I do. I'm looking way ahead. I'm looking at the end of next year because
end of 2017.
End of 2017, because we've been diligently putting together the strategist table, which is on the Bloomberg terminal, and we've got about 11 estimates in so far from Wall Street strategists. And guess what? They're feeling pretty bullish. This is after, largely after the sort of rotation that we've seen here post-election, and a lot of people thinking that some of these fiscal policies by Donald Trump, president-elect, are going to do pretty well. They're going to boost the S&P 500. Right now, they're predicting it's going to go to 2317. That's about a 6% gain from where it is right now, 127 points. However, let's flip it over to my other chart. If you look at what's going on the volatility curve, traders maybe not quite as convinced that the good news is here to stay, because what's interesting here, we pointed this out yesterday with Ed Machine of BNP, is that look at the curve here right now, the orange line here. It's just as steep as it was before the election, even though the spot VIX has come down. So you're looking at volatility still, getting higher as we go ahead.
All right, so something to keep in mind there. I'm focused on the currency markets, and I'm looking a little bit more short term here. This is how currencies have fared since the election. If you come inside the Bloomberg, the peso is the worst performer here. The pound, actually the best performer. It was the big loser, of course, in the month of October following the Brexit vote. A lot of people don't see much in the way of politics hurting euro dollar either, because it survived so many near-death experiences in the past couple of years. We've got more coming up. This is Bloomberg. Bloomberg's world headquarters in Midtown Manhattan, this is Bloomberg Markets. I'm Scarlett Foe.
And I'm Oliver Rennick. Commodity markets are closing in New York, and what a week it has been for oil. Let's get the wrap with Abigail Doolittle.
What a week indeed, Oliver. Oil is up 12% this week. In fact, on pace for its best week, get this, since February of 2011. This, of course, on the OPEC supply cut deal, the first in 8 years. Investors are really liking the fact that 1 million or more barrels are going to come off the market every day starting at the beginning of next year. We just see this absolutely huge surge in price, and it's flown right through to the oil complex, the energy complex, in terms of the stocks, including Transocean, Helmerich and Payne, Newfield Exploration, and Marathon Oil. These are the best oil and energy boosts for the S&P 500 this week. Very interesting is the fact that Transocean, Helmerich and Payne, are both drillers, so investors clearly think that these companies are going to be able to get back to work. And the U.S. shale producers and the E&P companies also really benefiting. Not surprisingly, volatility has really flown right out of the oil market. When we take a look at the oil VIX over the last few days, we see an absolutely massive move down, a 30% move down. This is the worst weekly decline for the oil VIX on record, and supporting the idea that volatility in the oil market may continue to decline as oil moves higher, and perhaps the energy names as well. When we go into the Bloomberg and we take a look at #BTV5184, this is a long-term chart of oil in white, the XLE or the energy sector ETF in orange, and in blue, those are the areas when OPEC cut supply by 1 million barrels or more in the past. And we see that there are just massive gains up out of those other supply cuts. Lots of volatility as well, Oliver, but it does suggest that there could be some more upside ahead for oil and the energy stocks as well, Oliver.
Yeah, you got it. Lots going on with oil and energy. Not enough to hold up the S&P, but still doing well. For more on oil, let's hear from Bill Sonneborn, EIG Global Energy Partners President. He joined Vonnie Quinn and Nara Chahik on Bloomberg Markets, the European close.
Well, there's a bunch of news, clearly, with respect to a cut of 1.2 million barrels that was announced by OPEC, a tough-fought negotiation. The question we look at is not what happens to the short end of the commodities curve, which is what Bloomberg reports. And I think early in your show you said this is the highest rising week for oil since 2009. What we look at is kind of 3 to 5 years out, what happens in the context of prices of oil. And so you may have had a 14% rise in oil for January delivery, but oil for 3 years from January only increased about 4%. So it had a very small impact in kind of long-term investments that we like to make.
And let's face it, we're still talking about roughly $50 a barrel. We're not back at sort of the levels that we saw a couple of years ago. What in the bigger picture, so we have the OPEC deal. We also have a new Trump administration beginning to form now. We haven't an energy secretary yet, but we have a commerce secretary and so forth. Where looks attractive to you just in the last few weeks alone, given the changing landscape?
Well, what's really interesting is because this OPEC deal, you've seen a very rapid increase of prices of U.S. oil and gas companies. They're up on average nearly 14% so far this week. And that creates an interesting private-public arbitrage. So if you own oil and gas assets in North America, I would expect you to see a lot of near-term filings for IPOs over the course of the next 3 months as private managers like we take advantage of a very euphoric rush in equity prices to exit certain investments.
Really, just to push you on that before Nara asks a question, can you give us a little bit more detail on where we might look for some of those IPOs to happen?
Well, sure. You've seen a couple of filings in the case of natural gas producers in Wyoming. There's a number of Permian-based operators that are preparing for filings. Double Eagle is a perfect example that's been in the news. I would expect you to see those hit the market.
And you'll be getting in on the IPOs?
We typically like to make private investments, and then we'd sell them to the public markets.
Bill, I want to ask you about the longer term because, you know, as you say, you're looking sort of 3 to 5 years out. And if I can just bring your attention to this chart on the Bloomberg, which is showing the WTI December 2017 to December 2018 spread and showing backwardation here for the first time since 2014. Now, people sort of reacting a bit prematurely and thinking there might be supply constraints because, of course, with what we're seeing with the oil price, you would expect the U.S. shale producers to move in there?
It's a good question, but that backwardization is really interesting for two reasons. One, it's going to harm commodities traders that have been assembling lots of storage, and so the cost of storing oil is going up pretty substantially, and so a number of financial players that have been doing that arbitrage will be getting out. The near-term impact of that could be more oil coming into the system that could put short-term pressure on prices. At the same time, I think the long end of the curve, if you look at that flat curve, is really an indication that two things. One, people don't think the OPEC deal will stick long-term. And the second, people are starting to worry about substitution risk with respect to oil and gasoline, which really is driven by fuel standards globally, as well as the potential for growth of more electric EVs around the world.
Yeah, it's interesting because there are some saying that OPEC, may have a deeper motive, actually pushing a bump now, but looking to drive down the future price of oil. I'm wondering then what your longer-term perspective is as well for natural gas and LNG, despite, what the near-term boon and risk might be for them.
So we're bullish on natural gas. So we see it as kind of the bridge fuel for kind of the environmental standards set by the Paris Accords. You're seeing lots of substitution of diesel-fired power in places like the Caribbean, Latin America, and Africa with natural gas-fired power. And natural gas is quickly becoming a globally traded commodity, no different than oil. And when you look at kind of investments we've made over the course of the past year, it's indicative of that. We made investments in the Marcellus Shale in the U.S., drilling for natural gas. We made a private preferred with warrants transaction with Rice Energy, a U.S. publicly traded energy company that operates in the Marcellus, really financing their pipelines to get the gas from the Marcellus and dry gas Utica out of the Northeast. We made an investment in a pipeline that's going to connect that same natural gas gathering system to the Gulf Coast of the U.S., and we made a $1 billion investment in a subsidiary, convertible preferred, in a subsidiary of Cheniere for their Corpus Christi LNG export facility to take those natural gas molecules and export them to London, as London moves off of coal to natural gas and wind-fired power and potentially nuclear over the long term, and to places like Latin America, where we now have made an investment building a regasification facility, and we're building a gas-fired power plant near Santiago. So it's really kind of thinking of the value chain of how energy, where it exists in abundance, needs to go places where there's less of it.
That was Bill Sonneborn, president of EIG Global Energy Partners.
Let's check the headlines on Bloomberg First Word News at this hour. Emma Chandra has more from the newsroom. Emma?
Thank you, Scarlett. House Speaker Paul Ryan tells CBS's 60 Minutes news program he plans to propose policy that will focus on simplifying the tax code. He says the plan could, quote, fit on a postcard. He also says our thinking isn't how to redistribute income in America. We don't look at the economy as if it's some fixed pie, and we have to reslice the pie. The House has approved a $611 billion defense policy bill that rejects a number of President Obama's proposals for managing the nation's military. Lawmakers passed the legislative package Friday by a wide margin, 375 to 34. The bill now goes to the Senate, where a vote is expected early next week. The legislation would prohibit closing the prison at Guantanamo Bay in Cuba and would deny the Pentagon's bid to start a new round of military base closing. Two shooters unleashed terror in San Bernardino a year ago, and county employees are remembering their fallen colleagues with a moment of silence today. Community members will gather to remember the 14 people killed and 22 wounded, with addresses due from religious leaders and law enforcement. Dozens of cyclists have embarked on a 14-mile bike ride through the city, marking 1 mile for each of the victims killed in last year's terror attack. And voters in Austria will get a do-over on Sunday. The Green Party's Alexander Van der Bellen won last May's presidential election by 0.6%. But Austria's constitutional court overturned the results. So now the Freedom Party's Norbert Hofer is hoping to become Western Europe's first right-wing head of state since World War II. The post is largely ceremonial, but both candidates have pledged to assert more power if elected. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg Scarlett.
Thank you so much, Emma. Coming up, President-elect Donald Trump's views on business. Names like Stephen Schwarzman, Jamie Dimon, Mary Barra joining his economic panel. We'll explore what that means. This is Bloomberg. Markets. That's according to the Wall Street Journal, which cites a memo. The memo says the action is aimed at balancing risk, revenue, and profitability. Deutsche Bank has confirmed the memo's contents. Ford is recalling 680,000 cars, most of them in North America. There are potential seatbelt problems in some versions of the Ford Fusion and Mondeo, as well as the Lincoln MKZ. Ford says there have been 2 accidents and 2 injuries linked to the problem. And the fashion industry is poised to recover in 2017 after one of its toughest years on record. A report from consulting firm McKinsey predicts that overall industry sales will rise as much as 3.5%. The reasons: an improving global economy and restructuring measures by brands like Burberry and Ralph Lauren. And that is your Bloomberg Business Flash. Oliver?
In politics today, President-elect Donald Trump named Blackstone Group CEO Steve Schwarzman to chair his President's Strategic and Policy Forum. The forum will be made up of business leaders who will advise the White House on how government policy affects growth, job creation, and productivity. Other CEOs who are members include Mary Barra of General Motors, Jamie Dimon of JP Morgan, and Disney's Bob Iger. For more on who Trump is surrounding himself with is Bloomberg White House correspondent Margaret Talib from D.C. Margaret, more and more every day from Trump, and now we're finding out that there's going to be some more folks from Wall Street that are going to be surrounding him. What exactly is the purpose of this group that he's assembling now?
Let's talk about politics first, because I think that is a really important part of this group. This is going to be very early, just days into his presidency, that this is planned for. And this is all about assuring a couple of people. It's about assuring sort of mainstream Americans for whom all of these businesses and CEOs are familiar names: Disney, Walmart, et cetera. And also, it is about assuring Wall Street that Donald Trump has the economy front and center on his mind. So it's a very interesting both collection of people and timing of today's announcement.
Margaret, didn't President Obama have something similar? He put together a group of people who he consulted with or who counseled him on the economy and on jobs. Do we remember if it resulted in anything actionable?
The purpose was very much the same, although the context of the timing, of course, was a little bit different. As we all remember, President Obama taking office and, in fact, winning election during the time of this massive financial crisis in 2008. And his idea was twofold: number one, to assure about the economy, and number two, to assure that he wasn't just sort of out there, a liberal Democrat in left field, not willing to work with Wall Street. Donald Trump coming from a different perspective, but again, so much the campaign was about economic populism, what isn't fair, and curbing Wall Street. So to that extent, it is very much a coming home for Donald Trump and kind of a reconciliation with Wall Street to show that he's serious about tackling the economy.
Margaret, I want to talk about another story that was pretty interesting here in the past 48 hours, which was a little bit of a clash at the at a Harvard forum between Clinton's campaign managers and some Trump folks as well, where basically Joel Benenson said that while yes, Trump won the electoral vote, that's the currency, I believe the word is he used, by which we elect our president, but he doesn't have a mandate. What does that mean? How does Trump not have a mandate if he's won the election?
Of course, the way you win presidential elections in the U.S. is through the Electoral College, but the popular vote matters when you're talking about mandate. And if you are Hillary Clinton or one of her supporters, you will always point to the fact that she won that race in terms of the popular vote. That's just not how you win the race for president in the U.S. But what that exchange at Harvard really showed is how raw these emotions still are. To the extent that they reflect how divided the country is, we'll see that in the coming weeks, but certainly in campaign world, in that world of Democratic and Republican strategists, and particularly in these two camps, Trump world and Clinton world, there's still a tremendous amount of tension and bad feelings, not just about the outcome of the race, but about some of the tactics and appeals to voters used in those closing weeks.
And perhaps what was most notable is who wasn't there, right? It was Steve Bannon. There were 6 Clinton campaign staffers versus 5 Trump campaign staffers, and Steve Bannon was the elephant in the room in that he wasn't there, and he didn't obviously contribute to this forum. Talk to us a little bit about the role that Steve Bannon plays now. Are we expecting to hear from him publicly, or is he only really whispering in Donald Trump's ear right now?
It's a fascinating question. I think in terms of yesterday, there was a recognition that he could become a real lightning rod and some protesters on campus, regardless of whether or not he was going to come. But look, from Stephen Bannon's perspective, he wins either way. I mean, he's going to be certainly in the White House advising Trump on a daily basis about approach and communication strategy. But for many of us who are going to be covering this White House, a real interest in how much of a public figure he will be and how much he will remain behind the scenes. Either way, he's going to be exerting a lot of influence on helping Donald Trump to understand kind of what's incoming and how he should deal with his outward-facing approach. And a couple of questions will be whether he brings sort of a Breitbart approach. Certainly in terms of a new media approach, Steve Bannon can advise Donald Trump. But it's one thing to run a campaign, one thing to advise a campaign, another thing to govern a country. Sure. When you say you want to unite, we will see.
All right, thank you so much, Margaret Talib in Washington. She's Bloomberg's senior White House correspondent. Lots going on with Trump, as always.
All right. Meantime, we've got some breaking news. Pandora has been approached by Pandora's board, or I should say by SiriusXM's board, for a possible takeover. So this is to express renewed interest in a takeover of Pandora. This is according to people familiar with the matter, and it's really a follow-up on an offer from earlier this year. So again, SiriusXM Chairman Greg Maffei recently approached Pandora's board to express renewed interest in a takeover. You're looking there at SiriusXM shares down 6.8%. You can see the leg lower following the release of those headlines.
And Pandora doing about the inverse of that. Shot up originally to above 1350, where it was trading about 12.5 earlier in the day, but coming down a little bit here. So kind of the typical takeover versus the target price moves.
And Sirius had offered about $15 a share to acquire Pandora earlier this year. No word on whether Greg Maffei, sorry, I mispronounced his name, had come up with that price tag again. So we'll keep you posted on any developments. Coming up, we're digging into the November jobs report. Are U.S. workers about to see faster wage growth as the market gets a bit tighter? This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu.
And I'm Oliver Rennick.
And we want to recap the breaking news we brought you earlier. Pandora's board has been approached by SiriusXM for some takeover possibility. And of course, this is Chairman Greg Maffei recently approaching the board of Pandora to express renewed interest in a takeover of the internet radio company. This is according to people familiar with the matter. Alex Sherman, who helped break the news for Bloomberg News, is here with us now. And this is following up on an offer from earlier this year.
Right, and it's following up on a report earlier today from CNBC. So what we're learning is a little bit different. Pandora has not actually gotten back to Sirius yet expressing, hey, look, we want to do this with you. All we know at this point is that very recently, Sirius chairman Greg Maffei approached Pandora's board and said, look, we're still here. We realize that you've taken some steps to sort of retool your business from the last time. That's the offer that you're referencing, Scarlett, where there was some chatter about an offer around $15 a share, which is something that we confirmed independently that is in fact true. Obviously, Pandora didn't go for that price. There was no price attached to the most recent approach. However, a part of this that's certainly worth highlighting, and it's part of the reason that the shares are up, I think, on this news, is that advisors for Pandora have actually started to solicit interest from other parties.
What, drive up the offer price?
To see if other companies are interested in acquiring Pandora. Perhaps they're willing to pay more than Sirius.
So is this Sirius wants Pandora because they fit a certain niche into their business, they provide something they don't have, or are they generally have money to spend, they want to build out their business in any way possible?
No, you know, this combination between Sirius and Pandora has been rumored for years. Sirius obviously has their legacy business. They've made great inroads into getting into both new and used cars. Moving into streaming has long been thought to be the biggest threat for Sirius satellite radio. Why do I need Sirius radio when I can just get all my music or podcasts online? Particularly as connected cars start to become enabled with Wi-Fi. So if you can acquire Pandora, then you sort of take out a competitor. Pandora is a huge business in terms of users. So the combination does make some strategic sense.
So given all that, are there going to be, let's just say they do move ahead or they explore the possibility, are there going to be antitrust concerns?
The world is so big at this point, I mean, in terms of Apple and Spotify and Google, if you want to get in, that the barrier to entry for this is only somewhat high. So, yeah, I'm sure antitrust, there would be mild antitrust concerns. I don't think that regulators would look at this one at the top of the list and say that's one we can't let go through. I'm not an antitrust lawyer, so it's certainly possible that there may be concerns that I'm not thinking of, but just on the face of it, it doesn't strike me necessarily as one that I'd put at the top of the warning list.
So it seems like Pandora at this point is a little bit reticent to sort of jump into a deal before either maybe getting other offers, really ironing out the number. But Pandora itself, it's not all rosy there. I mean, there's obviously more and more competition. While they were sort of first into this space, you've got all kinds of products popping up. Is there any risk here that potentially Sirius, if they want to get into streaming, there's other ways to do it, right?
That's right. There are other ways to do it, and there theoretically are different ways that not only Sirius can go into streaming, but there are other ways Sirius could, say, expand their business. But Pandora has so many users at this point that there are actually only so many companies in Sirius's price range that are sort of viable targets. I suppose they could go after Spotify, which is a private company. So that's another one that I theoretically could be out there for them if they decide to go that route. But the dialogue between Sirius and Pandora has been going on now a little while. Greg Maffei, the chairman of Sirius, and of course Liberty Media owns about half of Sirius, has been publicly vocal about his interest in acquiring Pandora. So this seems to be the most logical combination. Now the question is there an Apple or a Google or a Tencent or someone out there that might be willing to pay up even more for Pandora? And that's what I think their advisors are going to try to find out now.
All right, very interesting. Great reporting, as always, Alex. We'll certainly have you back as we get more information on that. That's Alex Sherman, deals reporter for Bloomberg News. And speaking of antitrust, we'll dig into how President-elect Trump will deal with antitrust concerns in just a few moments.
In the meantime, coming up, IMF Managing Director Christine Lagarde is next in an exclusive interview. She discusses the outlook for rebuilding U.S. roads and rails, the infrastructure revival. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu.
And I'm Oliver Rennick. From Bloomberg World Headquarters in New York for the next hour, plus covering stories in Chicago, Washington, Germany, and Saudi Arabia. Here's what we're watching. Markets getting ready to close for the week. Stocks are mixed. Financials are the laggards on the day as well as the week, as real estate and utilities lead the gainers today, but pretty bad on the week. Also, what kind of president will Donald Trump be when it comes to competition and antitrust? Some early clues indicate he may be more favorable than first thought. And in moments, we'll have an exclusive interview with IMF Director Christine Lagarde. She'll address plans to improve U.S. infrastructure and the president-elect's views on trade. and we are 1 hour from the close of trading here in New York. Let's get a check on the markets with Abigail Doolittle. Abigail?
Hi there, Oliver. So not a lot of action for stocks here in the U.S. going into the close. We have the Dow, S&P 500, and NASDAQ all basically unchanged, flipping between very small gains and losses. This may suggest that investors are considering the jobs report for the month of November a bit of a non-factor, despite the fact that there are some mixed signals in there, but probably gives the Fed the okay to go ahead with the rate hike that everybody is expecting later this month. As for what's interesting this week, we appear to have been going through a bit of a sector rotation. We go into the Bloomberg and we take a look at G hashtag BTV 2160. This is a month-long chart of various sectors. In white, we have technology. We see this massive decline down. And in orange, we have the energy sector. Energy, of course, getting the big pop on oil rising on the OPEC supply cut deal, the first in 8. So it appears that money has gone out of the technology sector into the energy sector and trading well right out of the election all along. Not so much this week, as you mentioned, but we have the financials. So there does appear to be a pretty interesting sector rotation going on here. And this on the week is influencing the major averages. When we take a look at the Dow, S&P 500, NASDAQ, and Russell 2000, the Dow is the only major average right now on pace for a very slim gain on the week. That does reflect some of that energy strength, while the S&P 500, NASDAQ, and Russell 2000 are all trading lower on the big declines that we just looked at in the technology space. Finally, some news today on Eli Lilly. Shares of the big cap pharma company are popping higher on the news that the FDA has approved the company's Jardiance drug for a new indication for patients with diabetes, and Evercore ISI is bullish on this and bullish on the shares of Eli Lilly. Oliver.
Thank you very much, Abigail.
Now let's get to Bloomberg's First Word News. Emma Chandra is in the newsroom with those. Emma?
Thank you, Scarlett. More meetings today at Trump Tower as the president-elect fills out his cabinet and senior staff. Among those on Trump's agenda, former Defense Secretary Robert Gates, David Malpass, the founder of Ensema Global, former UN Ambassador John Bolton, and Democratic Senator Heidi Heitkamp of North Dakota. This weekend, Goldman Sachs President Gary Cohn will return for a second meeting with Trump. Cohn's been mentioned as a possibility for several jobs, including budget chief. Michigan's elections board is deadlocked on President-elect Donald Trump's request to prevent a recount. That means unless the courts intervene, it will start next week. Meanwhile, Michigan's Attorney General is asking the state Supreme Court to intervene and stop the recount. That motion is pending. A Wisconsin recount is underway, though Trump supporters have filed a federal lawsuit to try and stop it. And in Pennsylvania, Trump is asking a court to dismiss Green Party candidate Jill Stein's recount request. Ireland's Prime Minister says the UK's decision to leave the European Union stands in stark contrast to its history as a forward-looking player on the international stage. Enda Kenny sat down today with Bloomberg editor-in-chief John Micklethwaite and recalled his reaction to the Brexit news.
Britain was always a really important member of the European Union and was a voice for change and was a voice for a vision for the future. Obviously, the decision then in Brexit came as a shock. It's something I didn't want to see, something that I didn't want, but I have to respect because it's a democratic decision, so we get on with it.
Kenny also said the UK won't be allowed to pick and choose which aspects of the EU it wants to keep as it prepares to leave the world's biggest trading bloc. And in South Carolina, jurors say they have failed to reach a verdict in the trial of a white former police officer charged with killing a black motorist during a traffic stop. The judge has asked them to resume deliberations. Cell phone video shows Michael Slager shooting 50-year-old Walter Scott several times in the back after Scott left his car and tried to run. Slager testified he'd feared for his life after Scott got hold of his taser. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg. Scarlett.
Thank you so much, Emma. Now to a Bloomberg exclusive. IMF Managing Director Christine Lagarde spoke today with our editor-in-chief, John Micklethwaite, as part of our Enterprising Women series. We asked her about President-elect Donald Trump's plans for tax cuts and infrastructure spending to boost the U.S. economy.
I would preface any comment with, we're a bit lost in conjecture for the moment because there are certain things that are coming back, whether it's the spending on infrastructure, whether it's the tax reform. There are things that we hear that are hinted more than affirmed, such as the trade policies. So it's very premature to sort of draw conclusions at the moment. But we have consistently said that the tax system in this country needs to be reformed, needs to be simplified, that corporate tax needs to be lowered and tax loopholes eliminated, that at the lower end of the income range, less taxation would be extremely beneficial for growth. So on the tax front, if what we hear is heading in that direction, this is beneficial on two fronts. One, on growth, because it would certainly boost growth, and it's also beneficial on the risk of a very divided society, with the elite of the haves and the elites and the others, the have-not. But it's a question of how that tax reform is designed, okay, and how many jobs are created as a result. Second area where is the beginning of proposals are also welcome is in the area of infrastructure. Infrastructure is badly needed in this country. Whether it's port, roads, railroads, airports, there has been reduced public spending on even the maintenance of what exists. So this is needed. How it will be financed, whether it will be public funding, whether it will be incentives to the private sector, is also going to matter in terms of output. So in the short term, if you only take those two blocks of proposals, it's rather positive for the United States. But it needs to be factored into a longer-term proposition. And clearly with entitlements kicking in 2021 or so, with baby boomers retiring, with interest rates likely to rise, and certainly interest repayment rising at around the same time, the decisions that are made today, to the extent that they possibly increase inflation, that they make financing more expensive, that they strengthen the dollar, all of that is going to also have an effect.
Do you see a stronger dollar as just? Do you see a stronger dollar as just a given over the next few years?
It's very likely. If those policies are implemented, it's very likely, and it will have both good. Well, it will have downside and upside consequences.
What about the obvious? If that is the obvious good thing about Trump, from your perspective, presumably the worry is trade. And especially the idea of maybe a trade war with China or any of those particular. Recently, there have been somewhat more clement noises about that. Do you think that's a fair reading?
Well, the more moderate approach to trade is probably predicated on the fact that trade has been beneficial, and has been beneficial not just for the 100 millions of people who have been taken out of poverty around the world, particularly in Asia, but around the world, but has also been beneficial in terms of improved competition, better allocation of the factors of production, including capital, certainly lower prices for consumers in the advanced economies, which have generally benefited, in particular, people at the low income level.
What about the issue?
When you realize all that, you sort of consider whether trade is not actually a reasonably good thing, but, and that's where I would be very interested also to hear what will be, it needs to be associated with clear measures that will benefit people who have been left out. So, because if you combine international trade and the massive increase that we've had in the last 30 years, the technology improvements, and it's very difficult to dissociate the effects of one versus the others, but they are combined, and they've created pockets of unemployment, people completely left out of their jobs, factories that have closed, and regions that have been devastated. That needs to be addressed. It cannot just be about trade is great, cheaper products, more consumption, better allocation of the factors of production. It needs to be trade that benefits all. And for the moment, that second part, which is addressing the issues of dislocation of supply chains, people displaced, people out of their jobs and out of any training, that is
surely
critically
the problem there is that.
You just heard from IMF Managing Director Christine Lagarde in an exclusive interview earlier on Bloomberg.
Coming up, we look at President-elect Donald Trump's approach to M&A and antitrust issues and whether he'll block the merger of AT&T and Time Warner as he has indicated. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu.
And I'm Oliver Rennick. Let's turn to the topic of mergers and acquisitions under a Donald Trump administration. During the campaign, the president-elect took a hard line against one high-profile deal, that's AT&T's plan to buy Time Warner. Here's what Trump said in October.
As an example of the power structure I'm fighting, AT&T is buying Time Warner and thus CNN, a deal we will not approve in my administration because it's too much concentration of power in the hands of too few.
So has his mind changed? Let's get some more insight from John Butler, Senior Telecoms Analyst for Bloomberg Intelligence, and Jennifer Rees, Senior Analyst for Litigation and Antitrust for Bloomberg Intelligence as well. Guys, thanks so much for joining. Jennifer, I want to start with you because I'm looking through the notes that you sent before the segment, and you say that Donald Trump, the president, has no power to stop this deal. And I'm a little dubious on phrases that start, the president has no power. So explain what you mean by that.
Well, I suppose it should have been phrased has little power, has some power, but not the ultimate say in what happens with a merger that may violate the antitrust laws. I mean, it's a really, sort of deep decision-making process, and the two antitrust agencies that oversee mergers, the Federal Trade Commission and the Department of Justice, ultimately the decision-makers there decide whether they want to sue to block a deal that they think violates antitrust laws. And I think the important thing to understand is that even those agencies, even though they've been given antitrust enforcement authority, don't have the ability to stop two companies that have entered a deal from closing that deal. They have to go to a court, they have to seek an injunction, and a judge has to order that injunction. They have to win in court. So a president can say, hey, to the people they appoint, I don't like this deal. Think about this deal. You know what my agenda is. I don't like this deal. But those enforcers are usually people who are antitrust thinkers, who apply a fact-based analysis. And frankly, if they don't have the evidence to support the fact that the deal violates the law, they're not going to want to go before a judge. And even if they do, this judge could be an Obama-appointed judge or a Bush-appointed judge. They might not necessarily be, pushing the new president's agenda.
All right, so there's what the president-elect said, and then there's what he can do. John, what about the companies themselves, AT&T and Time Warner? Have you heard any noise from them? Are they positioning themselves one way or the other now that we have a Trump administration coming?
I mean, great question. I think they're working it behind the scenes, as a lot of companies do when there's a deal pending. You know, the president's power really resides with the FCC. You know, he has appointees there. Frankly, I'm surprised we're even talking about this. I mean, this FCC is changing from a Democrat-controlled agency now to a Republican-controlled agency, which I imagine is going to be very pro-deal.
Even though Donald Trump has said that
he
would not approve this kind of deal.
You know, he hates the media. You know, he really is at war there a little bit, and I think that was part of the rhetoric. But I think the reality is the people he has in place really want to see regulations, a pullback in regulation of not just telecom. I think overall in the business landscape, they want to see less regulation, and that tends to favor approval of the deal, in my view. So I think AT&T and Time Warner are probably working some backroom deals to see how they can get this done.
It kind of sounds like one of those situations which Trump has said a lot of things. Sometimes even the people he surrounds himself might not be completely in line with that. But let's look at what the situation has been under the Obama presidency, because, of course, in the news, we've had a lot of these deals that have come under quite a bit of scrutiny. How is that poised to change here? And has it been a period where there have been more of a spotlight put on these big deals?
Yeah, I think that is the case. I think we have seen more aggressive enforcement in the Obama administration. Ultimately, at one level of enforcement, I think we've seen the Obama administration appointees at the Department of Justice and Federal Trade Commission as people who are more willing to actually go to court to try to block a deal. What we saw in the George W. Bush administration was just as much investigation, as much skepticism and questioning of these big deals, but less of a willingness to go to court. So backing off, allowing them to go ahead and enter a remedy, sell off assets that maybe today they wouldn't agree on. But I totally agree with John that what we're seeing, not just at the FCC, but possibly at the FTC and DOJ under Donald Trump, are people who may be much more friendly to business, you know, lighter on regulation, more likely to think in terms of the efficiencies that come from some of these deals rather than the harm that come from the deals. We don't know yet who Trump will be appointing at the FTC or DOJ, but we do know the people who are in charge of that transition effort, and they are what you might think of as traditional Republicans. You know, let the markets regulate themselves, hands off. You know, we don't know how to regulate a business.
And that would suggest that deals would be allowed to go ahead. Yes. John Butler, you've written about potential deals that could now be resuscitated or could come together as a result of Trump's presidency. One such deal could be Sprint and its possible remerger, or rethinking a merger, I should say, with T-Mobile. Talk to us about how you see this possibly playing out.
Well, I mean, let's start with the fact that if you look at the wireless market in any given large country, but particularly in the U.S., I really think it favors 3 carriers and not 4. And that's something the Obama administration has been very stuck on, 4 big players, right? That's right. And so you're always kind of left with one that's struggling. It was Sprint for years. They're starting to recover a bit. The one that's been ceding share a little bit is AT&T. They can afford to do it for a while. But, you know, the reality is scale matters most in telecom. And so I think a combination of Sprint and T-Mobile would make for a powerful combination, and one that could really compete with AT&T and Verizon, where today they're kind of living in their shadow a little bit. You know, they can't really do the big deals like go out and buy a Time Warner. And if you look at the market for media now, for telecom, there's a convergence happening between cable and media. And that, once again, I go back to how important scale is in being able to get that done.
I want to close here by talking about getting your take, Jennifer, about what this might mean for corporations that are now looking at this sort of antitrust from, you know, prior to Bloomberg. This is a space, this is a part of the legal space in which you work. So if you're a corporate CEO or you're a deal maker, do you have to start thinking about who you need to bring on board to be able to fend off potential antitrust regulation scrutiny if you're going forward with a deal?
Well, I think the advice would be that you have a better chance now. And, you know, we might even already be seeing in the market some of that reaction, because we had seen talk of a combination between Lynda and Praxair, and then they walked away from that, and a lot of people said this could have an antitrust problem, and now we're seeing that they may be talking again. I think that what you tell them is that, think about the efficiencies and the innovation that could come from the combination, because I think these are areas that some of the new decision makers in the antitrust agencies might focus on more than they have in the past, and that you might have a better chance of crafting some kind of a remedy that could be acceptable, going ahead and getting cleared with divestitures that might not have been acceptable before. But I think the thing not to forget in a very, very big global deal is that you're still in front of the EU and possibly China. These are very activist enforcers, and your deal could get blocked in those jurisdictions. So it's not a done deal, even though you're getting through the U.S. more easily.
Very good stuff. And I will add, in markets, there's a lot of M&A sort of premium baked into these companies, so it's going to be interesting to see how that plays out. Thanks a lot to Jennifer Rhee and John Butler, both of Bloomberg Intelligence.
Still ahead, with stocks hovering around record highs, are there any bargains left? Well, we look to Germany for some trading ideas in today's Options Insight. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu.
And I'm Oliver Rennick. It's time now for Options Insight with Abigail Doolittle today. Abigail?
Thanks, Oliver. Joining me from the CBOE in Chicago is Alan Nuckman, Chief Market Strategist at Bullseye Option. Thanks so much for joining us today, Alan. We really appreciate it.
Good afternoon, Abigail.
So on the week, we have the S&P 500 set for its first weekly decline in 4, possibly a lower weekly close. What do you make of this?
That's very significant. That's a key reversal where we made new all-time highs and a lower weekly close. So that could be a pause in the marketplace. We're also seeing the VIX bottom out. What's interesting is the VIX never went below 12, never ventured down, and never made new relative lows, even though stocks made all-time highs. So this may be the sign of caution here in the near term, and we'll want to keep an eye on it. But it's two different markets right now. You've got the Dow and the S&P together, continuing to make new highs, and you've got tech, which didn't even get close to its October 25th top.
Yeah, lots of talk about the sector rotation, asset class rotation. And speaking of the other asset classes, right now, according to the RSI, we're looking at an oversold signal on gold, an overbought signal on the dollar and the U.S. Treasury yield. What do you make of this?
Yeah, we're seeing some possible reversals in a lot of these markets. So stocks are topping out. We've got Treasuries got overdone to the downside here, made some new relative lows, and yields have really spiked up. But is this for real? I don't think so. There's a 98.5% chance we're going to raise rates in December, so that's a done deal. And they're pricing another rate hike in May and another one in December of 2016. So it's not going to be as quick as some people may think. And if you look at gold, it made new lows yesterday and at a higher close, so that could be the sign of a bottom. 1150 is a critical number number. That's really the halfway point between the 1,000 low and the 1,300 recent highs in gold. So it looks like we're finally finding support as the dollar stopped going higher.
Well, speaking of reversals, you have a pretty interesting trade idea here, which is around Germany stocks. We have German stocks slipping down over the last 2 weeks as the S&P 500 has carved out new highs. Can you take us through your trade?
Well, we're seeing markets moving in opposite directions. So typically they're very correlated, the German stock market, the DAX, and the S&P. Now, in the last couple of years, the DAX has declined, and it's actually down 8% this year, whereas the S&P is up 8%. So I'm looking forward to play some catch-up over a long period of time and buying a long-term option as a stock substitution strategy. So at January of 2018, so that's more than a year of time, the 22 call, which is in the money, we're trading about 25 right now. That 22 call is going for about 375. So the break even on it is very, is about $1 away from where we are right now.
I'm Emma Chandra. Let's get to Bloomberg's First Word News. The state-sponsored hackers who unleashed a digital bomb against key parts of Saudi Arabia's government over the last 2 weeks have damaged computer systems at the Saudi Central Bank. That's according to people briefed on the strike. The attack targeted at least 6 government entities with a computer-killing malware. It appears to have come from Iran, but the investigation is still in its early stages, and so that determination could change. The U.S. has hit North Korea with a fresh round of sanctions for what Washington calls continued provocative behavior. The U.S. will freeze the assets of some entities and people with suspected ties to the regime of Kim Jong-un. The new penalties follow a sweeping round of UN sanctions to cut off foreign trade revenue. North Korea calls the UN action an abuse of power, and it's promising to retaliate. A New Jersey judge has denied a request for a special prosecutor in a criminal misconduct complaint against Governor Chris Christie. The complaint is tied to the George Washington Bridge lane closing scandal, in which 2 of Christie's former top aides were convicted on felony charges. The judge dismissed the motion by a former firefighter who alleges Christie failed to order his subordinates to reopen bridge access lanes in September of 2013. And sweeping bipartisan legislation to support weather research and storm predictions has passed the U.S. Senate. If approved by the House and signed by the President, it will become the first major piece of weather legislation adopted since the early 1990s. The measure also reforms NOAA's weather satellite programs after years of cost overruns and delays. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg.
Live from Bloomberg's World Headquarters in New York, I'm Scarlett Fu.
And I'm Joe Weisenthal. We're 30 minutes from the close of trading here in the U.S.
Treasuries rising as the dollar declined after the latest jobs report delivered a mixed picture on the strength of the labor market.
But the question is, what'd you miss?
Unemployment falls to 4.6%, the lowest in 9 years. Signs of enduring labor market growth that'll likely leave the Fed on track to raise rates this month. And political risk building across Europe as we head into an action-packed weekend for Italy's referendum vote and Austria's presidential election. We look at the potential fallout areas. And an exclusive sit-down with IMF Managing Director Christine Lagarde. She says that the Brexit negotiation will not be a walk in the park. Highlights from her conversation later this hour. Let's get you started with a look at where the major stock indexes stand. I can't get my words out. It is Friday as we head towards the close. Abigail Doolittle has more. Abigail?
And happy Friday to you, Scarlett, and to you, Joe, and to all of our viewers as well. And going into the close, not a lot of action for U.S. stocks. We have the Dow down ever so slightly, the S&P 500 and the NASDAQ trying to eke out small gains. Now, interestingly, this is a big reversal from what we're looking at on the week. On the week, the Dow is the only one of the three major averages higher for its fourth week in a row, while the S&P 500 and the NASDAQ are both lower for the first time in 4 weeks. The NASDAQ significantly so, down more than 2.5%. Now, this divergence on the weekly performance among the major averages could have something to do with a sector divergence or sector rotation, excuse me. When we take a look at some of the sector ETFs and indexes, we see that energy and banks, these are doing really quite well this week. Energy, of course, getting a nice boost from the OPEC decision to cut supply, which has boosted oil on pace for its best weekly increase since February of 2011, up more than 10%. The banks getting a boost from the rise in yields, not today, but on the week, whereas we have weakness in retail and tech. Really, that weakness in tech. Tech has really sold off this week, and it looks like some of that money has gone right into the energy sector and continues to go into the financial sector. Now, a lot of people are talking about not just this sector rotation, but also an asset class rotation. We go into the Bloomberg and we take a look at G hashtag BTV 5205. This is a longer-term chart of the Bloomberg Barclays Global Aggregate Bond Index. And last month in November, it was the biggest decline in value. $1.7 trillion came out of global bonds, the biggest on record since 1990. Not surprisingly, much of this money seems to have gone right into U.S. stocks. When we take a look at a U.S. market cap index or average for the month of November, we see that $1 trillion was added to U.S. stocks in the month of November. Interestingly, though, there is a $700 billion hole there. Of course, commodities had a very strong month in the month of November, but there's a very good chance, Joe and Scarlett, that much of that money could be sitting right on the sidelines in cash, especially ahead of not just that Italian referendum, but of course the FOMC rate decision later this month.
$1 trillion, pretty incredible. Thank you so much, Abigail Doolittle.
What'd you miss? America's labor market gets tighter with the recent wage drop seen as just a blip. Let's dive into more of those numbers from this morning's jobs report with Matt Boesler of Bloomberg News. He's here with 3 charts you can't miss. So kind of an interesting jobs report today, strong on the headline. Unemployment rate of 4.6%, gotta love that, but wages a surprise. Let's start with the first chart you brought in here. Gen X employment, people aged 35 to 44, looking pretty good.
Yeah, that's right. So overall, a pretty good report, and I think this was probably like the best way to see, what a bright report this was. The 35 to 44-year-old age group we commonly think of as having like the least excuses to not be working of any age group. So,
they're out of college,
right.
They're not retirement age yet.
Exactly. So this maybe is the purest cyclical read we can get from looking at different age groups, and what you see here is that the most in this age group are employed as a percentage of that population since...
That's the blue line, right?
Yeah, exactly, since 2008. And we're
That's
finally
really cool.
getting back to levels that are consistent with the previous cycle, and you can see that labor force participation hasn't risen as much as employment has, which implies a very low unemployment rate for that age group. So that's a great sign.
That's a cool chart.
That's a good sign, but with that unemployment rate falling to 4.6%, everyone always asks, is it falling for the right reasons?
Yeah, and I think the signs from this report are that, yes, for the most part it is. The labor force participation overall did drop a little bit this month, but not as much as the unemployment rate did.
Okay.
So that implies that, this big drop in the unemployment rate we saw isn't all just people leaving the labor force or anything like that. It really is people finding jobs.
And what are people saying about the wage number? That it was a blip? That is, you don't want to read too much into 1 month?
Yeah, so there was a little bit of a statistical anomaly, a calendar quirk based on sort of the day of the month that the survey week fell into this sort of thing. So it's kind of a technical factor that we've seen, over certain months in the past year, and then these things typically tend to reverse the following month. So that very well could happen again next month.
Got it.
Let's talk about part-time work. Once upon a time, it was seen as bad because it meant that people couldn't get full-time work. That was the best they could get, these part-time jobs. But that's not necessarily the case, and it seems like there's a preference towards part-time employment.
Yeah, so the Bureau of Labor Statistics asks people who take the employment survey whether they're working part-time for economic reasons, which usually means that they can't find full-time work, or is it for non-economic reasons, which basically means, they prefer a part-time job. And what we see in this chart, the blue line shows the percentage of employed workers who are working part-time for that quote-unquote non-economic reasons.
Because they want to.
Exactly, and you can see that's come up a lot. The white line shows full-time employment as a percentage of total employment, and that has flatlined, but the point here is that the bigger share of part-time employment is actually coming from people who prefer to work part-time, whether that's older people who are sort of retiring or just looking for part-time work, or sort of this rise in sort of the sharing economy, allowing people to do other things.
So it's really important, because often you hear this criticism, it's like, it's all part-time work. That's not really true, but even within the part-time work, you have to look at how many people are doing it because they can only find part-time work versus people that's all they want to have.
Yeah, that's exactly right. You've probably heard that, over the last few months, a lot of job gains have been coming from part-time work, but the point is it's for those non-economic reasons, so that's not necessarily such a bad sign.
All right, let's look at your third chart here, which is the white line, aggregate weekly payrolls growth. And the blue line is U.S. personal consumption growth. So what do you see here?
Yeah, so the white line basically multiplies the number of people working by the number of hours per week they're working by the amount of dollars per hour that they're making. So it's sort of that total paycheck. And you can see that growth in that total paycheck has been slowing a little bit. And this is, of course,
part of the century before Lehman, I suppose. So that will be the headline, but you know, we're certainly not out of the clear. When I saw the minus 0.1 wage number and the revision or the YOY coming down from 2.8 to 2.5, to me it indicated that things are just not as hunky-dory as the stock market seems to think it is.
Bill, I want to fold in here the politics of the moment. You have been critical of some of the statements of the president-elect. There is an assumption within Trump reflation of a higher inflation and a better good for all. Can you state that, or is there a risk here of bad inflation with no real growth?
Well, there is that, and you know, inflation and productivity go together in terms of nominal GDP, and I have a sense that nominal GDP will be elevated by many of the programs, whether it's corporate tax cuts or infrastructure programs, et cetera. But future growth is primarily a function of productivity, as is inflation. If productivity is high, then inflation is contained, but productivity has been flatlined for the last several years, and while you know, Keynesian programs, and that's, remember, that's remarkable for Republicans. It's like a 180-degree turn. But while Keynesian stimulus in the form of tax cuts and spending and deregulation promise a near-term boost for productivity in 2017 and 18, they're likely to be temporary, in my view. You know, the counters to this view is that there's a strong dollar now and continuing structural headwinds, including aging demographics, deglobalization, trade policies, and accelerating debt and leverage that we've seen in almost all countries. And that promises to contain productivity at perhaps 1% annual growth rates, and therefore, to me, GDP growth rate at 2, and perhaps inflation higher than that at 2.5 to 3. So nominal at 5. Some of it, or majority of it, may be being inflation.
We need incentives from Washington. Does that come from a good old 1960s tax credit, or can we really trust the Secretary-designate and the President-elect to effect a broader tax policy?
No, to me, Tom, tax credits, while they've been effectively used 10, 20, 30, 40 years ago, you know, these days they don't make as much sense. They don't have the multiplier effect that they used to have, and the reason is that you know, corporations have ample use of money. They've been able to borrow at near 0% interest rates now for several years, and if they were going to invest or wanted to invest in a thriving economy, then certainly they would have by now. So a tax credit, you know, will do little, to my way of thinking, to generate economic growth far and above what we're seeing now, which is really a 2% or 1.5% type of growth rate. I think the government has to get more involved, has to be more Keynesian, has to be more jobs-oriented themselves as opposed to the private sector.
And that was Bill Gross, fund manager at Janus Capital, speaking with Tom Keene.
So how will the Fed read into the jobs data? We asked Mohamed El-Arian, Bloomberg View columnist and Allianz chief economic advisor, that question when he was on Bloomberg TV earlier today.
Short term, it's a Goldilocks report. Yes, the unemployment rate came down. We had solid job creation, but the wages were very subdued. So short term is Goldilocks. Longer term, it points to the structural challenges. We had a lower participation rate. We have real puzzles about wage formation. So it's an interesting mix. I think for the Fed, it encourages the Fed to hike in December if it needed more encouragement. The only thing that would hold it back now was a truly disastrous European follow-up to this weekend's election. But otherwise, domestically, this encourages the Fed to hike, but importantly, it doesn't make the Fed change its mind as yet about the path of future rates. And that's why the market response is so subdued.
And so take us into that path, because a lot of people are saying what really matters is what we expect in 2017, not what we expect in December. So what do you expect out of the Fed at this point? Is it 2 rate hikes next year?
Yeah, I think 2 rates hike is the most sensible projection given what we know. We just have to attach a lot of uncertainty because there's fluidity not just on the economic front globally, but also on the policy front now in the U.S. So I think the central projection, the baseline is 2 hikes, but one has to be humble about the degree of uncertainty.
Mohammed, obviously we saw a big pullback in treasuries in the month of November, the biggest on a monthly basis since 2009. Does the market price in this trajectory that you're talking about once in December, twice next year?
Yeah, I mean, the pullback was mainly because expectations have changed on the basis of announcements. And the expectations now, whether you look at the Treasury market or whether you look virtually at any other market, is higher U.S. growth, higher U.S. inflation. And that is what has been priced in. Now, markets have rushed to price that in based on announcements. There's design and there's implementation. So there's still 2 critical steps, but I think the market reaction is totally consistent with what we heard from the president-elect and his team.
Well, Mohammed, there is a tension, as you just suggested, between what the markets are pricing in bonds, on the one hand, and the expectations of Fed rate hikes. Now, over the last couple of years or so, when the markets have disagreed with the Fed's come to the markets rather than the reverse. Are you expecting at this point that the markets are going to have to readjust to the Fed expectations?
So this time around, as you say, David, it's the markets that are readjusting towards the Fed expectations. Another way of thinking about it, if you see what's implied by markets, it's moving up towards the blue dots, or what individual FOMC members think the rate path looks like. So this is different, and the reason why is because we have a whole set of policies that possibly will finally be activated. Fiscal, deregulation, and we also have other elements that are coming in, including corporate tax reform. So yes, finally, it's the markets that are moving towards the Fed rather than the Fed moving towards the market.
That was Mohammed El-Arian, Bloomberg View columnist and chief economic advisor at Allianz.
Time now for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. Apple and European Union watchdogs clashed in public for the first time since regulators ordered Ireland to recover $14 billion in back taxes from the tech giant. The EU says Ireland granted unfair deals that reduced the iPhone maker's corporate tax rate. Apple says the EU decision implies its products are made in Ireland and not the U.S. The EU scoffed at the notion, calling it a quote-unquote story. Ireland has filed an appeal. SiriusXM Holdings recently approached Pandora's board to express renewed interest in a takeover of the internet radio provider. This is according to people familiar with the matter. Sirius's latest approach did not include a price, but remember, it did offer about $15 a share to acquire the company earlier this year. Pandora has not yet responded to this latest Sirius approach. The Chinese group looking to buy AC Milan Soccer Club wants to delay the sale until next year while it waits for authorization from Beijing. That's according to people familiar with the matter, who say that the group is in discussions with former Italian Prime Minister Silvio Berlusconi's holding company. Now, an additional non-refundable deposit of $107 million to delay the close is among options on the table. Starbucks CEO Howard Schultz has his next chapter already mapped out: luxury coffee shops that sell ultra-expensive beans. Schultz steps down next year as CEO of the caffeine empire. He's planning to roll out flagship stores called Roasteries and a line of premium coffee called Reserve. The first roastery opened 2 years ago, offering coffee at $20 a pound. And that is your Business Flash update.
And as Scarlett was just saying, Starbucks CEO Howard Schultz will hand the reins to a 33-year veteran of the tech industry. Can he keep the momentum going for the world's largest coffee chain? This is Bloomberg.
Scarlet Fu, what'd you miss? Starbucks CEO Howard Schultz will be stepping down next April. So let's take a look at how the stock has fared under his leadership. So this is a ratio of Starbucks shares to the S&P 500 Consumer Discretionary Group that it's a member of. And when the line goes up, Starbucks is outperforming. When the line goes down, Starbucks is underperforming. The yellow shaded portions, and this is on the left side of the chart and the right side of the chart, is when Schultz was CEO. Remember, he was there for 2 separate periods. He took a break from 2000 to 2008, and he was called back to rescue the company. And we put the y-axis in log form, in log scale, so you can really see the outperformance, Matt, over here of the early stint of Schultz's tenure from the, late 80s, mid 80s until 2000. That was the first stint, of course. Now, yesterday, as we've been reporting, Kevin Johnson, who's the president and COO, it was announced he will take over as chairman, as CEO of Starbucks. Howard Schultz will stay on as executive chairman to really overlook the strategy, the retail strategy, especially when it comes to those premium stores. One thing that's interesting, of course, Joe, is that Kevin Johnson is a tech industry veteran, and this really speaks to how much Starbucks really depends on the innovation from its mobile payment system that it introduced a couple years ago.
And like every company wants to be a tech company these days, right?
But Starbucks really has done it.
No, they really have done it. You're right. It's not to be dismissed.
Yeah, I mean, people order their stuff over their smartphone. They go over and they pick it up.
No, it's been really impressive. I'm looking at the opposite of tech. I'm looking at gold, and particularly gold ETFs. This is pretty extraordinary. If we go back to the end of this chart here, this is total holdings of gold ETF assets have declined, that white line, for 15 straight days. The blue line is the price of gold itself, which has bounced around. But money is just racing out of the gold ETFs. And you can kind of think of gold as a negative yielding bond because it's a safe haven. But unlike with bonds where you collect a coupon, you have to pay to store it because you have to, gold is a high storage cost. So it kind of has a negative interest rate, which means that when rates are rising like we're seeing right now, it really makes holding gold less appealing, hence the flood of money coming out of these ETFs.
Although you wonder, with inflation picking up and everyone looking for inflation to rise, maybe that'll start to turn around.
Maybe people will buy it again for that reason.
All right. The market close is next. Take a look at the major indexes with less than 4 minutes to go before the close. The Dow is down right now, but for the week, it is the only one of the major indexes that is higher. Dow currently losing 27 points, S&P unchanged. This is Bloomberg. We're moments away from the closing bell. What'd you miss? The U.S. stocks were largely steady after the monthly U.S. jobs report showed signs of ongoing strength in the labor market, and unemployment fell to the lowest in 9 years. I'm Scarlett Fu.
And I'm Joe Weisenthal. Want to welcome our viewers who are tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern Time.
We begin with our market minutes. Kind of a ho-hum day here for U.S. equity indexes. I can't really dress it up when the S&P 500 is up less than 1 point and the Dow is off by 0.1%, down 20 points. Volume, Joe, off by 18% from the 20-day average in Dow Industrial Stocks. And this is even after you had a jobs report to get people excited.
Yeah, but even the jobs report, I guess, it wasn't directional enough. Like, it was good, but it wasn't that great. It wasn't, there's no raging wage inflation.
True.
Which would probably force yields way up. So just kind of like no story, no reason to trade today.
Yeah, it was kind of like, okay, this is confirmation of what we already knew. Yeah. So if you look at the sector breakdown, exactly, early weekend. If you look at the sector breakdown here, it's a little bit of a reversal of what we've seen the last couple of days and weeks. You've got interest rate sensitive companies doing better. So real estate investment trusts, utilities, staples with their dividends, they all gained quite nicely, while the financials, which had been the big winners post-election, were down 1%. Financials, in fact, even with today's drop, still up 13% after election day. Now, as stocks kind of falter or the rally stalls, however you want to put it, we see the VIX edging somewhat higher. If you look at a 5-day chart of the VIX, you could see that it's certainly come up a little bit there, but really far from the levels that we saw before the election.
Let's take a look at government bonds, starting with the U.S. 2-year and 10-year. We see yields lower across the board today. I think that weak average hourly earnings number relieved some pressure that the Fed might have to hike faster than expected. So kind of a meaningful drop there on 2-year and 10-year yields. Of course, those yields have been raging higher. Let's look at an intraday chart of the 10-year yield. Kind of gives the picture. 8:30, you saw a very quick sharp down, then up as everyone was trying to digest that jobs report that came out, and then just sort of mostly lower throughout the day. And quick look at Italian, actually, we don't have the Italian 10-year yield, but they have their referendum this Sunday, and it was down a little bit.
That's all everyone's paying attention to. With treasuries recovering a bit, as Joe mentioned, pushing yields lower, the dollar is consolidating some of its gains. So if you look at the Bloomberg Dollar Index over the past week, the Trump dollar rally seeming to stall out at the end of this week. The dollar falling for the 4th time this week. It did gain once during this week. But overall, if you look at a bigger, longer-term picture, the dollar index still holding near its highest level ever. One currency I want to highlight here was the rand. It got a huge boost. It rose the most among all the emerging market currencies versus the dollar. And of course, that line shows the dollar declining in value versus the rand. This is after S&P affirmed South Africa's foreign currency credit rating rather than downgrading it to junk status. So Moody's, Fitch, and S&P all keeping it above junk status. However, S&P did lower its local currency rating and warned that political interference in fiscal policy could maybe down the road lead to a downgrade.
And a quick look at commodities. Up across the board, across oil, gaining another %. Of course, oil had a huge week thanks to that OPEC meeting. Nickel and industrial metal doing well. We've seen the industrial metals do really well. And gold ticking up a little bit less than 1% today. And you got to look at a 1-week chart of oil.
Oh, yeah.
That's just a monster chart. 12% gain on NYMEX crude oil for the week. That's really the huge story in commodities. That OPEC meeting, the decision to cut was not expected by traders, and you could see how significant that repricing ultimately was.
A lot of people saying that decision was more political than economic ultimately in the end, that get everyone together.
Apparently there's a 2 a.m. phone call that sealed the deal.
Yeah, it's a great story available on the Bloomberg. All right, those are today's market minutes. We want to take a deep dive now into the Bloomberg. You can find all the charts using the function at the bottom of the screen. I wanted to show you Italy's report card, economic report card, before the referendum on Sunday. And this chart begins in February of 2014 when Matteo Renzi, now the prime minister, took power. The white line shows the number of households who say that their income does not meet expenses. It's come down by almost half. So when the line goes down, as it has here, it means people are meeting their expenses better. It's a measure of consumer confidence. But this improvement has come at a heavy price because you see public debt, this is the red line, has been soaring. It's now at 2.21 trillion euros. That is the highest among the euro area countries.
All right, joining us now to talk more about all this, Bloomberg Gadfly columnist Lionel Laurent, who writes about European banks. Thank you very much for joining us. So Italy really in the spotlight. There's multiple stories going on. There's the economic one. There's obviously the political one with the referendum. And then also the banking one, all sort of tied in. What's happening right now with the banks? Are they making more progress on figuring out some sort of resolution to this issue?
Yeah, so there's many different types of bank problem in Italy. Yeah. We all talk about Monte Paschi, right, which is a very small bank but with a huge bad loan problem. Monte Paschi has a radical plan that it's trying to pull off, but it's doing so in the middle of this complex referendum, and that's one of the feedback loop issues. It's not so much that the referendum really directly affects the bank, but that if Renzi resigns, if there's political instability, does that make it harder for the bank to raise capital on the market, and does that make it harder to negotiate with Europe if there is the need for a systemic bailout?
All right, Monte Paschi, as you mentioned, kind of a small bank. How emblematic is it of the Italian banking sector's problems? Are more banks like it than not like it?
It's hard to say. There's a real divergence, right? Because there are big, solid, systemic banks like UniCredit that don't really look like Monte Paschi on the surface, but there is an infection, a contagion problem, where market perception and sentiment, if it's a drag on Monte Paschi, if non-performing loans don't get cleared up, if the market for non-performing loans doesn't really accelerate, that hurts big banks too. That hurts the share price and the sentiment around it. So the whole thing is linked.
And just to underscore how it's hurt the share price, if you come inside the Bloomberg here, this is the member-ranked returns this year of the Stock 600 Bank Index. And you can see that these are the worst performers. 5 out of the 6 names here, the worst performers are Italian banks. You have names like Banco Popolare, UBI Banca,